scissors, but knowing I know he knows.
Scissors, shoot. Thought we were doing rock, paper, scissors, shoot.
It's always rock, paper, scissors. Think like a trader? Join the club, genius. Tasty Trade.
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
At Capital Group, our active ETFs are meticulously crafted, seeking to endure the ups and downs of the market and make a difference at the core of a portfolio. Which has a nice sound to it, doesn't it? Capital Group, actively different active ETFs.
Check out this move on crude. WTI up another 2.6%. Crude right now 76.31. That 5-day move, 5-day rally, almost 12% higher. 11.88% rally over the last 5 trading days. Under surveillance this morning, 1 year of war in the Middle East.
When we think about the threat that Hamas, Hezbollah presents, Iran, I think that it is without any question our imperative to do what we can to allow Israel to defend itself against those kinds of attacks, which include the need for humanitarian aid, the need for this war to end, the need for a deal to be done which would release the hostages and create a ceasefire.
So here's the latest. Israel ramping up strikes in Lebanon and Gaza as the nation marks 1 year since the October 7th terror attacks that launched the region into conflict. Joining us now is Bloomberg's Jumana Basechi for more. Jumana, good morning.
Morning. Well, it's October 7, and it is a somber day. It was a very traumatic day for Israel, but also a game changer for the country, because ever since that point, they have had to reconsider how they think about security and their place in the region. And if you fast forward to today, we actually just put out a Bloomberg Politics newsletter, the title of which said, "A Year of Middle East Tragedy," which really highlights all of the actions that have been set in motion over the course of the last 12 months. If you think about it today, Israel is fighting a multi-front conflict. You have the ongoing war in Gaza, and if you look at the latest death toll put forward by the Palestinian Health Ministry, we're looking at 42,000 deaths there. And even though Hamas have been very much diminished in terms of their military capabilities, even this morning, rockets were being fired towards Tel Aviv, claimed to have been fired by Hamas militants. Yahya Sinwar is still operating there. There's still 100 hostages still held in captivity with no signs really of a ceasefire breakthrough. You think about the developments in Lebanon across the border there. There's a ground incursion that has been going on for a week now, ongoing airstrikes around central Beirut, around the border close to Syria, rising death toll there. The Lebanese Health Ministry put it at 2,000, more than 1 million people displaced. And then in addition to that, you have ongoing strikes with these Houthi rebels in Yemen who have been wreaking havoc across the Red Sea shipping routes. And then the big one, of course, is Iran, because if you think back to the last 12 months, there have actually been 2 direct attacks from Iran into Israel, the latest of which occurred a couple of days ago. And now the whole world is on alert to see how Israel are going to respond to that. So it is a very fraught time, but also, I think, notably, the pathway towards normalization or peace in the region has never appeared narrower than it does right now.
Jumana, well said. Jumana Basechi there of Bloomberg out of the region. Let's continue the conversation. Joining us now is Elliot Ackerman, U.S. Marine Corps veteran and former White House fellow. Elliot, welcome back to the program. We're still sitting here waiting to see what Israel's retaliation might look like against Iran. We can get to that in just a moment. I think we need to reflect on the last year and the fact that the battlefront has got bigger and not smaller. And we've been talking about this now for the last 12 months. What does winning look like for Israel, Elliot? What does that look like?
I think it's really important that we differentiate between Israel having a right to defend itself, yes, but Israel winning. And I think as Israel's ally, the United States, I mean, we have an obligation to join with Israel to make sure that they win this war. That's actually the quickest pathway to peace is victory. So what does victory look like? You know, I would argue for the Israelis, they have strung together a series of successes in the last month and a half that they absolutely need to take advantage of. The successes being the decapitation of Hezbollah, the massive strikes against Hezbollah's leadership. I think they're at a point right now where if I were Benjamin Netanyahu, I would be strongly considering striking at Iran's nuclear capability and making certain that Hamas and Hezbollah are forces that can never threaten Israel again, and then looking to renegotiate security agreements in the region with many of the Sunni Arab nations that were poised to do so 1 year ago, right before the October 7th attacks.
Elliot, what do you say to those that say that if Israel was to do that, then it would probably push Iran to go even further and actually result in enriching uranium even further and developing a nuclear weapon?
Yeah, I'm glad you asked that question, because I think when we look at the war that's going on right now between Israel and Iran, and it is a war between Israel and Iran, it's happening in a broader context, which is the wars that are going on right now between a global axis of authoritarian nations, to include Russia. In that axis is also North Korea, and to a degree, China, that's tacitly allowing so much of this to go on. And so when we look at a country like Russia and Ukraine, one of the great mistakes and missed opportunities of the war in Ukraine was the fact that we, as the United States, didn't empower the Ukrainians to act decisively early on in that war, by giving them the weapons that they needed in short order, and allowed that war to drag out as it's now into its third year, and the cost for victory for Ukraine has become much higher. So for the Israelis, I would say if you want a long war, take incremental steps. If you want a short war, act decisively and try to achieve what seem for the first time now those attainable objectives. And I would not take too much counsel of people who tell you that you have to respect and fear these red lines, like the red lines Putin has put up and like the red lines the Ayatollah puts up, because I think ultimately they do not serve anyone's interest, and they don't serve the interest of peace.
The objectives are obtainable, Elliot, but you still have a scenario where on October 7th, a year on, Hamas is still able to fire rockets at Israel from the north. How much longer could this conflict stretch on, even if, as you say, it looks like if it has the support of its allies, it could get there?
Well, I think the first thing that Israel needs to recognize, and I think does clearly recognize, is that this is a war being fought by proxies. So, yes, it's a war against Hamas, and it's a war against Hezbollah, but it's really a war against Iran. And that by defeating Iran, by taking measures in which the Iranians no longer feel it's in their best interest to continue supporting their proxies, that's how you get these rocket attacks to stop.
Elliot, we've got to leave it there, sir. It's fantastic to catch up with you. Elliot Ackerman there, the former White House fellow on the latest situation in the Middle East, calling for an act of decisive measures going forward from here, and maybe even a strike on nuclear facilities.
Well, I go back to what the defense minister of Israel said over the weekend, Gallant, to Fox News, asked about this. Could we see nuclear facilities? Could we see oil facilities be the target of some sort of Israeli retaliation? The answer was all options are on the table. Very different than what we heard from this White House, which was definitively, please don't touch those nuclear facilities, and maybe best not to touch the Iranian oil facilities as well.
And increasingly over the last week, that's what this market has been pricing in, just the very real risk of that risk materializing. Right now, crude is up by more than 2% across the board. WTI 76.30. Brent crude getting closer and closer to 80, 79.80. Coming up next on the program, we'll catch up with Bob Doll of Crossmark, Heidi Kripo-Redeker of CFR, Torsten Slock of Apollo, who before he sits down will do a bit of a victory lap in a studio, I'm sure. Then we'll speak to Mike Collins of PGIM Fixed Income. All of that and more in the second hour of Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
We do think that near terms that the market could get choppy.
We actually expect some volatility here near term.
If you get a short period of volatility, we are absolutely going to be in there buying.
Any pullbacks here would be opportunities to position into equity markets.
This market has traded soft landing for the last 18 months. So I think the appropriate question is, what comes after soft landing?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Your equity market looks like this morning. Good morning, good morning. Pulling back just a touch on the S&P 500. We're down 0.5%. On the Nasdaq, we're down as well on the Russell. Just a little bit of underperformance there versus the S&P. On a Russell, the small caps down by 0.6. Surprise, surprise in the bond market. Not lower yields, much higher yields. After Friday's blowouts report, the move continues. We're up by another 9 basis points on a 2-year. Check this out. 4 handles across the curve. 2-year, 10-year, 30-year. The 2-year, 4.01%.
And the market doesn't know what to make of what is going on with this jobs report. Was it an outlier? Did the Fed act too quickly, cutting by 50 basis points? What Mark Rowan told you, Jonathan, a very expensive insurance policy. Unemployment rate down. Wage growth came in hotter. Revisions came higher. Usually revisions are coming down. So now what do you do with this all? Neela Richardson says this idea of a no landing. She says the plane has landed. This is a good economy. Then you have to ask, why was everyone pricing in another 50 basis points cut in November? That has now basically come off the table. And base case for most people is 25. Even some are saying no cuts.
Did we really need that 50? Check out the Fed minutes later this week for more on that. The main event, though, CPI on Thursday for the economic data side of things, and then the earnings on Friday. We'll get bank earnings kicking off with JP Morgan and Wells, but the standout main event after Friday's big jobs print, it's got to be Thursday and CPI.
That jobs print allowed us to move on to an old devil that we know. It is inflation. I think it's notable that today you have the bond market still selling off while the equity market decided to stop selling off, despite the fact that a blowout jobs report is good. It allows us to say, hey, the Fed's not behind the curve. Maybe it shows, as Jonathan Krasinski of BTIG says, that the upside is now limited. Not only do we apparently need to worry about inflation again, but we're heading into an election. The runway just isn't as big for equities, even if you have strong economic fundamentals.
Remember all that cash in money market funds still there, by the way? And everyone coming on this program saying trying to deploy that capital elsewhere. Go out along the curve's normalizing. It makes more sense to deploy that capital now. 2-year versus 10-year. Turned negative this morning.
Well, if you're worried about reinvestment risk, hey, good job. You can get back in now with higher yields. Maybe now is the time that we'll finally put cash to work. Probably not, considering it hasn't, considering people have gotten pretty used to being in cushy cash positions amid the uncertainty of the world. But again, that sort of criticism that you're missing something with yields starting to come down, now would probably be the opportunity to take advantage of that.
So here's the cross-asset picture. We talked about it a few times. Equities pulling back, yields pushing higher, the dollar stronger. Look at the euro, negative again, 109.66. Standout move this morning. It's not just the economic data, it's the move in the commodity market. Crude up for a 5th straight session.
And this is how basically this cloud hangs over the Middle East right now. What is going to be Israel's response? Two different stories coming out of Goldman Sachs and JP Morgan when it comes to the commodity market. Goldman Sachs predicting Brent could surge to the 90s if Iranian oil supply is hit. Goldman Sachs, though, says that attacking Tehran's energy facilities would not be the preferred course of action. And they're actually looking for Brent to stay around $80 this quarter.
Right there, right now, 79.83 on Brent crude. Coming up this hour, we'll catch up with Bob Dole of Crossmark, saying central banks are helping risk assets. Torsten Slock of Apollo saying there's no need for further rate cuts. And Michael Collins of PGIM Fixed Income saying it's time to add duration. We begin this hour with stocks on a 4-week winning streak following stronger than expected economic data in America. Bob Dole of Crossmark Global Investments suggests it's hard to be bearish. Monetary policy is now easing, even though there is limited evidence that had been a major drag for the US economy to begin with. Any caution towards equities has admittedly been wrong, or at least premature. Bob Dole joins us now for more. Bob, welcome back to the program, buddy. Let's just pick it up where we left things on Friday. Payrolls, big blowout jobs report is good news when you're seeing this repricing in the bond market.
First of all, it was 1 month. Look at all the prior months. How many downward revisions have we had? I'm not saying it wasn't a good number. It was an outstanding number, no question about it. But when you look at the employment data around the ISMs, both manufacturing and services, they were weak. So which is it? Which has it right? Time will tell, but the inflation question, as you've all just been discussing, is back on the table.
So, Bob, it just raised an important question. Which one was the head fake? The summer deceleration or the re-acceleration coming out of the summer?
I think they're both true. Economies don't move in one direction nonstop. I think we're going to have this fits and starts. Some people call it a bumpy landing. I like that term. And I think that's what we're in for. It's going to be a good number and then a not so good number. And it'll confuse all of us.
Yeah, great. Wonderful. Great to hear that, Bob. I know in the meantime, you are looking for a significant economic slowdown or mild recession. That had been at least your base case scenario. If this is just 1 month, does it change it at all, Bob?
It certainly lowers the probability of us getting that right. When I look at all the statistics over several months, to me, it's still pretty clear that the economy is slowing. We're seeing that in many of the employment numbers, notwithstanding last Friday's. We're seeing that in ability to find jobs, people trying to find full-time jobs, settling for part-time jobs. Economy's slowing. We just don't know how fast that's happening. And of course, the Fed has seen some of that too. We got 50 basis points. But their number is still very high relative to other things. How many things can you find that have nominal growth as strong as the Fed funds rate now? So it is leaning on the economy even with this cut.
Can you just help me sort out then what kind of economic environment we're dealing with here, Bob? If you're worried about a slowdown, but now we need to worry about inflation again, how do you square all of those?
Oh, that can happen in many, many cases in the past. Economy slows and inflation's picking up. I'm not arguing for stagflation, but we've had that many times before. And I guess I should enter the fact that PEs are in the 20s. When the PEs are that high, things better be nearly close to perfect. So if there's fly in the ointment, whatever that fly is, that 22 PE has got to be questioned somewhat. Hard to see a lot of upside for equities. Maybe not downside, but hard to see upside.
Bob, I know you keep trying to stress that this was to reconcile how good this month was, which all the survey data showing that actually jobs plentiful, that's coming down, while jobs hard to find. More people are saying that's what their picture is right now in the labor market.
That's why I'm raising the question that it's 1 month and all the other things, the same statistic prior months, all the other numbers are showing not so fast that the economy is great and that there are plenty jobs. So let's see what next month brings and watch all the other statistics that you just accurately point out.
Do you just then take maybe 60 or 70 off this payrolls report because of the revisions we've seen in the past?
That's probably not a bad thought. I hadn't come to grips with that, but that's probably a good idea.
Bob, I want to talk to you about what's happening in this bond market. We're starting to see a reinversion, never mind a disinversion. And Bob, I wonder for an equity market strategist, for an equity market investor, what they should be doing with what's happening in the bond market after we heard from tons of people coming on this program who were saying, get out of cash, deploy it into risk, go out further along the bond market, take on duration in the bond market, take on credit risk? Bob, what's your advice now?
Yeah, I think people that have a lot of cash that have enjoyed high returns, put a little to work. The 10-year over 4 is a whole lot more interesting than the 10-year that was below 375, not but a couple of weeks ago. So I would take periods of weakness in the bond market and do some adding. You don't have to be a hero, take your time. But that's what's weighing on the stock market, the rise in interest rates, the rise in oil prices. And, you know, maybe the economy is okay, the employment report may say. But on the other hand, why are earnings revisions so negative for the third quarter?
Hold up, Bob. This is an important point. Are you suggesting we've got to the point in the bond market where yields up on good news is now bad news for equities?
Yes, I think, you know, most people say when the 10-year gets above 4, we begin to have those problems. I don't know if it's exactly 4, but the pace of the increase in yields also, John, I think has to be brought into the equation, and that is weighing on stocks.
So let's get into the stock market. Lift the lid on the index. Where do you want to be? Where do you want to avoid with all of that in mind?
So I'm a broken record for quite some time. I've argued for companies with high earnings predictability, high earnings persistence, and strong and growing free cash flow. You might call that quality, because all the unknowns we've been discussing and debating back and forth here, I want to have companies that are somewhat independent of the economy. Those stocks have done just fine as the market has moved higher. I think if we get any kind of selling squall, these names will do even better.
Bob, does that mean this market's ability to broaden out, to go beyond the Mag 7, go beyond the cash-rich companies, go into small caps? Do you not see the market able to do that then if you're still looking at this maybe safer part of this equity market?
So I'm not sure that the Magnificent 7 or 5 or whatever the number is the safest part, because of the big valuation differential between the top 10, if you will, more than 30 times earnings, and the other 490, call it 18 times earnings. I think the market can continue to broaden. I'd say within the S&P, within large cap stocks, not so much down to small. We need confidence that we have a really good economy for the small stocks to do well. And as you probably know, almost half of the Russell 2000 companies are losing money. That's not real attractive.
So, Bob, in this environment where higher yields can indeed punish equity markets yet again, how worried are you for Thursday's CPI report?
I think we have to have our antenna up on it. Look, I never say, back to the employment report, 1 month makes a trend, but this notion that the Fed had inflation under control, it's going to inevitably get to 2%, has to be in question. I've questioned all along. I don't think there's any way we get 2% inflation unless we have a recession.
Bob Dole, across Smart. Bob, appreciate it, sir. You've been pretty consistent on that point. Good to catch up after payrolls on Friday. Looking ahead to CPI on Thursday. We're still vulnerable to this all flipping the other way with CPI on Thursday.
We are still vulnerable, and I think one of the important things that maybe we're missing is that 10-year yields have been moving higher since before the Fed's decision. This bond market has actually been telling us something even before the Friday pay report, that maybe 50 was too much, that maybe there's a threat of inflation reaccelerating, or maybe there's just so much volatility that you need to command a higher premium. There are still risks in this market that maybe we could ignore when we're all freaking out about recession, and maybe the jobs data lets us kind of put that back in the spotlight.
The commodity market's been a piece of that puzzle. The 10-year's up to 4%. The 2-year is up to 4% this morning as well. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Chevron has agreed to part ways with some of its assets in Canada. The energy provider will sell some oil sands and shale stakes to Canadian Natural Resources for $6.5 billion. The asset sale comes as Chevron focuses its growth plans on other parts of the world, most notably the Permian Basin here in the U.S. and the Tengiz field in Kazakhstan, where a $48.5 billion expansion project is almost complete. Meanwhile, Nikon shares are rising after revealing French eyewear maker EssilorLuxottica has taken a 5.1% stake in the company. According to a filing, the eyewear maker began accumulating Nikon shares in early August. Earlier this year, Nikon shared it plans to invest more than $600 million by 2030 to bolster its lenses and other offerings. And McLaren has announced the most powerful model it's ever made. The British supercar maker unveiled the W1 to mark the 50th anniversary of its first F1 championship. The W1 uses a hybrid gas-electric engine that can pump out nearly 1,300 horsepower, boasting a top speed of 217 miles per hour. If you're looking to buy one, though, bad news. Only 399 were commissioned to be built, and they've all been reserved. The car costs just over $2 million and will begin delivering in 2026. That's your Bloomberg Brief. John?
Yeah, Harry, thank you. Nobody around this table in the market for one, obviously. I think we all wish we were.
I feel like Piastri and Norris should get a commission for this car, because come on, part of the reason it's so popular is that they're so dominant right now.
Did they get a free one?
Oh, I'd hope so.
To find out, you'd think they'd get a free one.
You'd really hope so.
Part of the PR around the vehicle. Up next on the programme, crude rallies on risk in the Middle East.
Could you clarify some of your comments yesterday with regard to strikes on Iranian oil facilities? What did you mean by them, given some of the reactions we're seeing in the market?
I'd be thinking about other alternatives than striking oil fields.
We'll talk about those alternatives up next. Live from New York City this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep
World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
Risk assets facing a few headwinds this morning, including this one in the bond market. Yields higher by 4 basis points on a 10-year, up by 9 on a 2-year. We're back through 4% across the curve, 2s out to 30s. Under surveillance this morning, crude rallies on risk in the Middle East.
Could you clarify some of your comments yesterday with regard to strikes on Iranian oil facilities? What did you mean by them, given some of the reactions we're seeing in the market?
Well, look, the Israelis have not concluded what they're going to do in terms of a strike. That's under discussion. I think if I were in their shoes, I'd be thinking about other alternatives than striking oil fields.
So here's the latest this morning. Crude oil rallying for a 5th consecutive session as the world awaits Israel's response to Iran's ballistic missile launch last week. Heidi Kribo-Rediker of the Council on Foreign Relations says the real risk may be an additional strike from Iran. Heidi joins us now for more. Heidi, I want to read that line again. The real risk may be an additional strike from Iran. Just explain to our audience what you mean by that.
So I spent last week in Riyadh in Saudi, where, as you might imagine, everyone was pretty laser focused on whether what Israel described as a significant response to Iran's latest missile attack, whether it would involve striking oil facilities and infrastructure, as you were discussing. But while there was nothing explicit said, the worry was that that strike on Iranian oil facilities would result in Iran targeting Saudi and other Gulf producers. And so while they have, reasonable relations with regard to managing oil and oil facilities, I think there's legitimate concern that there would be a potential for a residual attack as an Iranian response on other Gulf facilities.
What about, Heidi, the idea that Iran can also close the Strait of Hormuz?
So, that is an option. There's some analysts that say that would be catastrophic. I think actually there are other alternatives. If there were an Israeli strike on Iran and Iran did close the strait, Saudi and UAE both have capacity. They have capacity to bypass the Strait of Hormuz, and I think they have capacity to export via the Red Sea. And UAE has a pipeline that also has the ability to bypass, which is a stopgap measure. But in terms of the direct impact, there obviously would be a significant market reaction. But I think in terms of global oil supply, it could really mitigate some of the disruptions.
Heidi, as you look to what Iran's response would be once Israel decides to respond to Iran, what are the Gulf countries doing right now to try to mitigate any of the risk?
So I think they are in significant quiet consultations with one another to try and really keep temperatures down. It's in nobody's interest to have this escalate, and particularly escalate into a full-blown regional conflict. That's not only bad for commodity markets, that's bad for global markets for a whole variety of reasons that you're aware of. And so I think that the general attitude is let's keep the temperatures down and the conflict as confined as possible.
Heidi, you were the State Department's first ever chief economist. You looked at things like state warcraft. What do you think the U.S., the Biden administration, is currently looking at, but to potentially harm Iran right now and as a punishment?
So, obviously what's on the table for first the Israeli response is military, nuclear, or the oil infrastructure. There are already so many sanctions on Iran right now. I'm not sure what additional sanctions could be contemplated, but I think, to the extent that the Biden administration has any sway over Israel, it would be to try and make sure whatever risk they're going to be undertaking is one that they fully understand and have some way to mitigate. But obviously, this is a highly volatile environment. The timing, given especially the auspicious date today of October 7th. I think that decisions are going to be made, and we'll see an imminent response.
Heidi, what I'm hearing from sources in Washington is that the administration is weighing idea of more sanctions. But is the issue more sanctions or just the enforcement of sanctions that are currently on the books?
So enforcement of sanctions would be a very important step. I think it's. Iran has been exporting and China has been importing, in particular, a significant amount of Iranian oil. But it's always a combination of stronger enforcement in addition to layering on additional sanctions. And as sanctions work when you have sanctions that are imposed multilaterally, far better than if you have just the U.S. Imposing those sanctions. So I'm imagining that conversations about sanctions are happening with allies and partners.
Heidi, can we do a little bit of scenario analysis? Because you said that the oil market could react really strongly with any Israeli attack on Iranian oil infrastructure. What could that look like?
So, I mean, you're seeing, you're seeing pressure on oil right now, and we've had. I mean, this is a crisis that's in a conflict that's 1 year into the conflict, and you haven't seen so much reaction in commodity markets, but the potential that we have now, Hezbollah has been to a large extent neutralized, and that was one of the bigger barriers to a direct attack on Iran by Israel. It sort of opens up the real possibility for disruption of a major producer and exporter.
How do you understand the Biden administration's ability, though, to speak to Israel and to be able to avoid something like that, to say this hurts us heading into an election and hurts other Israeli allies as well?
So the Biden administration has done its utmost to try and influence the actions of Israel. And I think, they're strong defenders of Israel. And they are, I am sure, having the conversations that will help inform at least thinking what a broader escalation might mean for the rest of the world. But I think Israel's going to make its own decisions at the end of the day. They've shown that time and time again.
Heidi, appreciate your input this morning. Thank you. Heidi Kruber-Rediker there of the Council on Foreign Relations, with crude higher by more than 2%, approaching 80 on Brent crude.
And just within a few days, you heard Biden really take that pivot. He almost let you in on some of the conversations that were happening. There is discussions regarding Israel attacking Iranian oil facilities. And then on Friday, he said, I'd be thinking about other alternatives than striking oil fields. And that happened after we saw the oil prices really spike and hold on to those gains. You cannot get rid of this geopolitical risk premium. And Heidi's point is not so much Israel attacking Iran, but what Iran will do after that potential attack.
It depends what the objectives are when we start to think about what Israel is going to do to Iran. Is it a proportional response to hundreds of missiles being thrown in their direction? I'm not entirely sure what that even looks like. Or is it go even further? Is it about really taking Iran on and ending what has been the axis of resistance for the last few decades?
Or is it potentially sending a message? We know where your nuclear facilities are. We know where your head IRGC individuals and personnel are. We really just need to wait. What we know now, though, is that according to Israel, all options are on the table.
Brent crude up by more than 2%. WTI as well, 5-day rally on WTI up by 2.5%, 76.30. Coming up on this program, Torsten Slock of Apollo saying the bottom line is rates will stay higher for longer. Torsten said it a few times. He does not think that this economy needs interest rate cuts. He certainly didn't think we needed a 50. He thinks this economy is better than okay. And if Friday's payrolls report is anything to go by, it certainly is. Your equity market's pulling back on the S&P 500. We're down by 0.5% on the S&P. In the bond market, yields are higher by 8 basis points. The 2-year at 4%.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
So before we get into this, Mike Dowler of Roth has this to say. The September jobs data was much stronger than highly correlated survey data for September, raising questions about its veracity and sustainability. We'll have a very different view on this in just a moment, but just throwing that out there. Equities look like this on the S&P 500. We're negative here. Across the board, we're down 0.5% on the S&P. On the NASDAQ, we're down by 0.6%. In the bond market, yields are higher. Bob Doll of Crossmark on the program just 30 minutes ago, making the case that maybe good news is now bad news because yields are back through 4%.
And what a joy that is for CPI coming on Thursday. Great, we have to worry about CPI again just when we thought we put it on the rearview mirror. I thought it was important, though, Bob kept emphasizing it is 1 month of data. We did this for the bad data. The bad data, we were able to say, hey, it was just 1 month, don't freak out. Maybe we should kind of approach it the same way, even if it is good data, that this is still an economy we don't fully understand, and especially a confusing labor market.
Back through 4 across the curve, 2s out to 30s. Let's turn the page and get to the commodity market story. I want to look at Brent crude and WTI. We're up by more than 2% on the session. WTI on a 5-day winning streak, a move of almost 12% over that period, a move of 9 to 10% just last week. Big weekly gain.
Big weekly gain. The market is fully supplied. Demand is not necessarily fully there because we're still waiting to see on how the stimulus effects will take place in China. The issue is right now is the commodity market is very angsty when it comes to what is going on in the Middle East, and they are preparing for potentially this Israeli retaliation on Iran and what Israel decides to hit. And oil facilities clearly are in focus.
And this is just, again, another thing that needs to make us worry about inflation once again. We did hear from Bank of America. They put out their projections basically saying for every 10% rise in oil, it's a 7 percentage point increase in core inflation. What that essentially means is that it needs to get back above $100 a barrel to start worrying about inflation again. But you add in oil, you add in China's stimulus, and it's, again, these fears coming back into the market.
Ed Yardeni, with his note over the weekend, before we get too cocky, we should note that we aren't completely ruling out the possibility of recession because of a potential 1970-style geopolitically triggered hard landing. He's looking at the crisis and what is going on in the conflict in the Middle East.
What did Mohammed say on this program on Friday? Mohammed Al-Arian, inflation is not dead. He thinks we should still be paying a lot more attention to that. CPI is coming out on Thursday. Under surveillance this morning, the U.S. Southeast, preparing for its second major hurricane in less than 2 weeks. Hurricane Milton could strengthen to a Category 4 storm as it moves towards Florida. The governor, Ron DeSantis, declaring an emergency in 51 counties.
Very sad what's going on right now in the southeastern states. Danny brought up a great point. A lot of those FEMA workers were leaving Florida to go help other areas. Potentially now they will need to be coming back. Also, over the weekend, Speaker Johnson saying there is enough federal funding right now. They don't need to bring Congress back. When you think of 2 potentially devastating hurricanes at the same time, maybe that changes.
And Anne-Marie, you've been great to point out that these are swing states that are being hit. Politico has figures that in 2020, Trump won 61% of the vote in the areas in North Carolina that have been declared a disaster after Helene. In Georgia, that figure is 54%. These are important regions for Trump if he wants to win these swing states.
And these are regions that right now, these areas don't have access, some of them, to clean water. They don't have the power, let alone are they really thinking about getting their balloted or lining up in a month's time. That's why this has become so politically charged.
It's a difficult situation, and it could get a lot harder. Elsewhere, Boeing and its largest union heading back to the bargaining table. A federal mediator summoning both sides for talks today over wage negotiations. Since the plane makers' last direct meeting on September 27th, there's been little direct contact between the parties. Situation now for the union, do they think they've got the leverage that we've seen on the eastern Gulf Coast ports over the last few weeks?
Well, one thing going for them is that the strike here doesn't directly impact people. It impacts Boeing, but their customers are used to having to wait for supply for a very long time. But it's interesting, the conversation has been that Boeing workers can continue to strike because of the gig economy, that they're all taking on second jobs. One person who is striking, speaking to Bloomberg, said that he's supplementing his income by making T-shirts and selling them. You get the sense that this is a workforce that is angry and willing to make some sacrifices to continue the strike on.
But last week, workers lost access to the Boeing-backed healthcare benefits. Potentially, that is what is pushing them to this negotiating table. They haven't been here since September 27th. So potentially losing that access, that benefit that I'm not sure you get when you decide to go into the gig economy, pushes them towards wanting to make a deal.
One to watch. Here's another one to watch. Rio Tinto approaching Arcadium Lithium for a takeover deal. If successful, it could be the most significant mining acquisition in over a decade. Arcadium's current market cap is $3.3 billion, about half of what it was worth at the start of the year. Rio Tinto, for a long, long time, it was iron ore, it was copper, it used to be coal, now it's aluminum. There's going to be a bigger and bigger focus on lithium in years and 10 years and decades to come.
Absolutely. Lithium, cobalt, this is what is going to power the future. And then when you look at what's going on in demand in the oil market, and you look at gasoline demand in China, it's less. Why? Because more Chinese consumers are buying cheap EVs out of China. To power that, you're going to need access to things like lithium and cobalt, and that's why you're seeing this stock really take a rise.
Big move in that stock this morning. Let's get back to Friday's blowout payrolls report, reshaping Fed expectations for the rest of the year. Torsten Slock of Apollo saying there's no need for cuts. Quote, the Fed is cutting rates, which is boosting growth and inflation further. Combined with very easy financial fiscal conditions, the bottom line remains that rates will stay higher for longer. Torsten Slock joins us now for more. Torsten, good morning.
Morning.
You caught your breath after the victory lap around a studio table. It's good to see you, sir. How did you feel on Friday when that number dropped?
Well, I think it makes sense what's going on. I mean, as you just talked about, it's not clear that the data has been slowing down. GDP last quarter was around 3. The Atlanta Fed GDP now for this quarter is around 3. And if you take this combined with, broadly speaking, strong data on consumer, on durable goods, it makes sense that the labor market is also still hot. It never made sense to say, oh, the economy is good, but the labor market is bad. You can't have it both ways. Either it's good in the economy and good in the labor market. You can't have that the economy is good and the labor market is bad. That just never made sense. So that's why, given the economic data coming in, the totality of the data, as Jay Powell would say, I still think that it's very obvious that things are still chugging along.
Well, let's sit on the totality of the data. So the survey data last week, the ISMs, employment components, not fantastic.
Well, the service headline was still good.
Well, we can get into that in a moment. The JOLTS as well. If you look at the JOLTS, job openings were up, but hiring was down, the quits rate was down. If things were great, you'd expect the quits rate to still be elevated. You'd expect hiring to be elevated too. Some people have pointed out that maybe this is inconsistent with the broader data. What do you say back to them?
Well, I think that what's going on in the JOLTS survey is really a normalization. Because in the JOLTS survey, what you also have that the layoff rate is still 1. The layoff rate has not gone up, meaning it's not the case that companies are firing workers. You know, on the other hand, just seeing a little bit less hiring. So that's just a normalization and combined, of course, with still steady immigration and at the same time tailwinds from defense spending, from AI, from energy transition, and consumers that are not very sensitive to interest rates going up because of locked-in low interest rates. We still have some fairly strong tailwinds to the outlook and less sensitivity to what rates are doing. So therefore, it still makes sense to believe that over the next several quarters, the economy will do just fine.
Well, it's that sort of thing that's allowed a lot of critics to look at this decision in light of the jobs data and say it was a mistake to go 50. But Torsten, is there a world where this jobs report wouldn't have looked as strong if they didn't go 50, that it helped maintain strength in the labor market and reinvigorate confidence?
Well, the key issue, of course, as usual, is what are the long and variable lags? The Fed textbook would say that's 12 to 18 months before anything starts to show up. But as we know very well, the stock market is now becoming a very important indicator for companies in terms of, are we doing well, are we not doing well, should we hire, should we not hire? And given the significant tailwind to risky assets, credit spreads are very tight, both on IG, high yield and loans, and also when it comes to the equities going up. All that may actually exactly imply that we have had faster transmission of monetary policy because the signaling, the forward guidance has been coming through much quicker than what the textbook would have predicted.
Does that suggest then 50 was a mistake?
Well, Jay Powell said at the press conference 10 times that they did this to recalibrate monetary policy. So there was a lot of this time, of course, discussion, as of course also you guys had a lot of, about why did they do this? What's recalibration as an excuse? And of course the excuse was inflation has now come down. But given that the economic data is still strong, it really is Goldilocks with inflation back close to 2%, and the economic data just continues to power along. So that's why the Fed is now stuck at a situation where they need to say, well, should we look at the economic data, or as you just said before, Danny, or should we turn to inflation and say maybe inflation is a risk of moving up again?
But when you look at the totality of data, and Jonathan pointed out that some of these actually are going in the wrong direction, besides this one unemployment point that was a blowout, do you think the Fed will err on the side of cutting too much rather than cutting too little?
Well, the Fed has definitely had a tendency that the risk to the unemployment rate for the last 5 years has always been, in their view, that it would go higher. So that's why a very important discussion on that is, of course, where do they put the emphasis? Do they put the emphasis now on that it's not really only the JOLTS data that's weakened, it's also a number of other indicators that have shown slight weakness when it comes to some specific small areas, but the vast majority of the data that comes in, consumers, in the daily data, you're still seeing restaurant data very good, TSA data for travel still very good. You also have the debit card data from my Bloomberg screen, and spending on the daily data is also very good. So you have across the board a lot of indicators that still continue to be really moving along quite nicely. There is just no slowdown. It's very clear that the JOLTS data stands out on its own as a very special story.
So November 7th, what do you think the Fed should do, and what do you think they will do?
Well, the problem for them now is that they have pre-committed themselves too much to R-star and to rates going lower. So that's why I do think that they will cut 25 basis points. But the key issue here is that all the incoming data being so strong is telling us that maybe R-star is not 3%, which is where the Fed is saying it is at the moment. Maybe it is more like 4.5%, which we do in our own Kalman filters of estimating where it should be. So that's why we think that we are not too far away from the monetary policy stance currently being close to neutral. So if that's the case, we don't need a dramatic amount of Fed cuts, which has been even also put into the dot plot by the FOMC members themselves.
You sound vindicated. Do you think Governor Bowman is as well on the FOMC? Has she got any company?
Well, she was the lone dissent, of course, saying, well, we should not have cut 50. Well, I do think that we'll get a lot of Fed speeches today, including Alberto Mussolem here at New York speaking, of course. So, but all that ends up, in my view, being very, very important for us to see, are they backpedaling now? Are they backtracking from this? Oh, we need a lot of cuts. Well, maybe we don't need a lot of cuts because the incoming data continues to just be strong.
They say they're not in a rush. Do you believe them?
I do believe them because think about what creates recessions. In 2020, the recession was caused by COVID. Of course, that generated recession. Lehman Brothers, of course, that generated recession. Prior recession, the S&P 500 went down 50%. That generated a shallow recession. And prior to that, we had the commercial real estate crisis and the savings and loan crisis in the 1990s. Of course, that generated recession. But where is the shock today? Where is the shock that should generate a recession? The only shock is we've had the Fed raising rates, but that's been countered by now AI spending, defense spending, fiscal spending. So that's why monetary policy has not been as restrictive as our textbook would have been saying. So that's why our textbook, we should probably put that more aside. And that's probably still a good recommendation for the Fed. Let's put this textbook aside and look at the incoming data, and the incoming data continue to actually be strong.
So if the neutral rate isn't as low, if monetary policy transmission when they're cutting is happening at a quicker speed, what will be the implication of them continuing to cut into strength?
Well, the challenge is that we still have the tailwinds from very strong spending from the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. We also have very strong tailwinds from AI spending. I mean, no one you meet says, oh, I'm not going to invest in AI because the Fed has just raised interest rates 25 basis points. Everyone still wants to invest in AI. And energy transition, we also have that as a strong tailwind. And finally, also deglobalization. The industrial renaissance, the construction of manufacturing plants in the US is also a strong tailwind. Those are things that the Fed can't really control because these are the stories that we talk about in markets at the moment. So in that sense, monetary policy is just unusually weak in terms of having a negative impact when rates went up on the economy.
Torsten, does the market still also have the tailwind of the Fed's first pivot of December 2023?
Absolutely, because in December, as we all remember, they clearly said now rates are going down. And before that, there was very little activity in IPO, in IG issuance, high yield issuance, loan markets. everything was relatively weak and, broadly speaking, at a standstill. After the December pivot, they really have seen a significant opening of financing markets in all directions, and that's also exactly as you're saying, Anne-Marie, provided a very strong tailwind in easy financial conditions. And therefore now, if you are a company that want to do something in private credit, in private equity, a lot of more things are just possible relative to what we had earlier.
Torsten, it's good to see you. Wonderful to catch up. Congratulations. So far, so good after Friday. Torsten Slok of Apollo. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Donald Trump and Kamala Harris taking a break from campaigning today to recognize the one-year mark of the Hamas attack on Israel. Harris will plant a pomegranate tree on the grounds of her official residence in Washington in memory of those killed, while Donald Trump will attend a memorial service with Jewish community leaders at one of his hotels in Miami. Meanwhile, Foxconn saw its revenue growth accelerate after it hit record sales for the third quarter. Also known as Hon Hai, the main manufacturer for Apple, saw a 20% surge in sales, beating its own expectations. That's thanks to its growing business supplying servers with NVIDIA AI chips inside them. And it was a busy weekend of playoff baseball in the National League. Both series are tied at 1 game apiece, with the Phillies coming back for a walk-off win over the Mets after dropping Game 1 at home. Out west, the Padres rolled over the Dodgers, and in the American League, the Guardians will look to pull ahead from the Tigers after taking Game 1 at home. And elsewhere, the Yankees will host the Royals for Game 2 this evening in the Bronx. That's your Bloomberg Brief. John?
Yahara, thank you. Regular Mets updates just for Bramo. Bramo's not here. This is where Bramo will be tomorrow morning. Do not miss this. 9:30 Eastern Time tomorrow. Lisa Bramett sitting down with the JP Morgan CEO and Chairman, Jamie Dimon. 9:30 Eastern tomorrow morning. Do not miss that conversation. Up next on the program, inflation isn't dead.
This notion that inflation is dead, this notion that we are mission accomplished, came way too early.
That conversation up next, live from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
% or so companies in production with their generative AI use cases. By 2026, I expect to see more than 80%. Getting started with structured data on day 0 can make your business stronger.
The delta of paper is equal to the partial derivative of rock with respect to rock, paper, scissors. Think like a trader? Join the club, genius. Tasty Trade.
Honey? But the gains are pumping.
Yeah, the market's closed.
Futures don't sleep in the after hours, bro.
Dad, is Mommy a finance bro?
She switched careers to make money for your weddings.
Ooh, penny stocks are blowing up. Sweetie, grab your piggy bank. We're going all in. Let me ask you, for your wedding, do you want a gazebo and a river?
What's a gazebo?
Something that your mother always wanted and never got.
Or you could give these different investment options a shot.
The right money moves aren't as aggressive as you think.
I'm keeping the best.
Here's the stock market picture for you. We're pulling back by 0.4% on the S&P 500 in the bond market. We're up by 3 basis points. The 10-year back through 4% for the first time since August. The 2-year also back through 4%. We're up by 8 basis points at the front end of the curve on a session so far. Under surveillance this morning, inflation isn't dead.
I think this is pushing back against what has been, in my view, and you've heard me say it over and over again, an overly aggressive expectation of rate cuts by the Fed. This notion that inflation is dead, this notion that we are mission accomplished, came way too early.
So here's the latest. The 10-year yield hitting 4% for the first time since August following the blowout jobs report on Friday, leading traders to cut the chances of another Fed rate cut, a big one of 50. The door closed on that on Friday. Mike Collins of PGIM saying this: we're sticking with our call that there is better risk return in adding duration here than cutting. Of course, it is difficult to have a high conviction call on rates one way or the other right now, as the economic data, jobs and inflation have really been bouncing around. Mike Collins joins us now for more. Mike, I want to pitch up on Mohammed's line, and welcome to the program, sir. The notion that inflation is dead, this notion that we are mission accomplished, came way too early. Mike, do you agree with him?
No, I don't, right? Jonathan, we're paid really in this business to look for different paradigms than the one we're in. A lot of people this morning after Friday's, really strong jobs number are kind of jumping back on the strong growth, high inflation narrative bandwagon. And, there are other scenarios out there. Like I said, this is very difficult, right? Forecasting interest rates and even the path of the economy are always difficult. Today, just as much so. I mean, just look at the climate risk we're facing in the last couple of weeks in this country, right? I mean, it is a tremendous destruction of wealth, but it can also be inflationary. So you have a tug of war going on just from that one exogenous effect that we're seeing increasingly around the world. But there's this scenario, Jonathan, that prices stop going up, right? If prices, which are high across a lot of different categories, just stop going up for a year or two, inflation goes to zero, right? And that is a scenario that we're actually starting to put a little more weight on as a risk scenario that, heck, maybe these 0.2 and 0.3 inflation prints, which we're expecting later this week, turn into zeros and 0.1s, and then you're running at year-over-year inflation below 2 in 6 and 12 months from now. That is not at all out of the realm of possibilities. And in that world, rates are possibly 100 basis points too high. So I know Torsten Slok is painting a picture, maybe rates are 100 basis points too low. Maybe they're 100 basis points too high. And it is really difficult. But as investors, as long-term investors, you have to take into account all of these different scenarios.
Well, Mike, that's what it takes to make a market. Two very different views. So let's run with yours. We've got a 2-year right now that's reset at 4. The whole curve has reset higher in and around 4%. What do you do with this morning?
Yeah, I mean, we're advising our clients, and in fact, in our portfolios, we've gotten a little bit long duration, right? A month or two ago, when the 10-year was pushing down at 360, and there were tons of rate cuts priced in, it seemed like a little overdone in the near term. And I know we've spoken about that. And we were advising clients, hey, if you ever get an opportunity to buy the 10-year, in that 4 to 4.5% zone again, don't miss it this time. Take advantage of it. And right now we're right at the bottom, of that buy zone is what we're calling it, right? And I think, investors are probably going to take another bite at the apple here. I mean, we've seen flows coming into public fixed income in a pretty big way. They actually accelerated recently with the Fed's 50 basis point cut and with a slowing in economic and inflation data. And I think maybe investors this time will be emboldened to take advantage of this backup in rates and add duration. And I really think over the longer term, that's the right thing to do.
Mike, there has been some pressure on duration since even before the Fed cut 50 basis points. From the 16th of last month, the day before the Fed decision, 10-year yields nominally up 15 basis points, real yields up 19 basis points for the 10-year. What do you make of the drivers behind that? It's counterintuitive. You think the Fed's cutting, surely yields would be going lower across the curve.
Yeah, I mean, the markets overreact all the time, Danny, right? And I think that's what happened when the Fed, did the 50. The markets kind of raced ahead of them for even more cuts, right? There were, a full 75 basis points of cuts, almost 50 at each meeting at one point priced in for this year. I mean, that did feel like an overreaction in the near term. And I know this is giant liquid, most traded market in the world. U.S. Treasuries are supposed to be an efficient market, but wow, human behavior really forces markets to overreact on the upside and downside all the time, especially during inflection points. So I think that was just a near-term overreaction on the downside, and the market started to realize that and get back to a more normal level, pricing in a longer-term funds rate of close to 3. Now, to your point, we're almost 50 basis points of cuts have been taken off the table. We're kind of around a 330, 340 long-term funds rate right now, what we call the terminal funds rate this cycle. And could that happen? Could they stop at 340 and stay there forever? Yes. And maybe that's the view of the kind of the economic and inflation, bulls and hawks. But man, there's a whole host of scenarios out there where they get that funds rate into the 2s or God forbid, maybe even lower than that. And I think the markets now are maybe starting to go back up too much here and not price in those downside scenarios to growth and inflation.
And then you get to your call that way, Michael, of saying get out of cash, get into duration. I got to ask, are clients actually listening to you? Because cash funds have just been so much more sticky this cycle than so many people anticipated.
Yeah, they have. But I mean, you look at the flows, and we see our flows across a whole variety of different institutional, global, non-U.S., pension, insurance, high net worth investors, Danny. So we have a really neat spot where we sit to actually see every day the shift in the money. And increasingly, we are seeing the bigger investors, even retail investors, looking at fixed income and probably public fixed income, right? Because private fixed income has been really sticky, and there's been some disappointment in the liquidity there. Big money coming back into public fixed income, and yeah, maybe they get a little bit spooked with this backup in rates and pause for a little bit. That's very natural behavior, looking in the rearview mirror. But I think if you do get a rate settling here, kind of in the low to mid 4s. It's a big long-term buying opportunity, and let's hope everybody takes advantage of it.
Mike Collins of PGIM with a rallying call. Get into this bond market. Appreciate it, sir. As always, the opportunity to get another bite of 4% in the bond market.
Yeah, everyone was saying, hey, the reinvestment risk, it's here. You missed it. Already yields were going down. They're back up again. So if you liked yields below 4%, surely you'll love them back above 4% yet again.
If only that's how it worked, right? You get back through 4, you start worrying they're going to 450 and maybe even higher. The 2-year at 4% this morning, up by 8 basis points. On a 10-year, we're up by 3, just north of 4%. Up next on the program, Ed Yardeni of Yardeni Research, Dana Telsey of Telsey Advisory Group, Greg Dacko of EY, and Eric Knudsen of Neuberger Berman. The third hour of Bloomberg Surveillance is up next.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is not just a solid labor market, it's a strong labor market late in the cycle.
This is not as tight of a Fed as the market, or really as the Fed thinks it is.
It's a labor market that looks okay, and probably 50 basis points is off the table.
It doesn't feel like monetary policy needs to be acting at a fast pace. We expect it to be more gradual.
The economy is okay, and there's not any forcing issue here to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, the third hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500, on the Nasdaq 100, on a Russell, down across the board. On the S&P, we're negative by 0.4%. On the Nasdaq, we're down by 0.5. On a Russell, we're down by 0.4. On the S&P 500, a 4-week winning streak on a weekly basis, the longest going back to May. If you get to the bond market, the picture is very different this Monday compared to last week. Back through 4% briefly on a 2-year, likewise on a 10-year, 3.99. In and around 4% across the board this morning. Yields are higher at the front end by close to 8 basis points. Danny Berger, the commodity market, the source again for some of this move this morning.
It's inflation back in the concern. It's not just the commodity market, which it is largely. It's strong jobs, and it's also China policy. Stimulus coming into the fore. Remember that old thing of stimulus in China impacting the entirety of the globe? So you get this concern, not just stimulus, not just the oil market, but maybe the Fed policy cutting by 50 is the thing that reinvigorated this jobs market. And then transmission of policy happens quicker, which means the neutral rate isn't as low as we thought, which means more cuts aren't coming as much as we thought, which means that yields need to go higher.
We're getting some upgrades from Wall Street, from Goldman Sachs and David Costin. New price target for year-end, 6K, up from 5,600. 12-month price target now 6,300. I mentioned Michael Wilson over at Morgan Stanley. Overweight on the cyclicals relative to the defensives. Max Kettner, HSBC. The jobs report reaffirms our very bullish stance on risk assets. Stuart Kaiser of Citi. Take a listen to this. There's a window for markets to rally into the election. saved the Middle East an escalation or a large upside surprise in inflation on the 10th of October. Let's talk about the Middle East and the prospect of escalation. 5 days of gains for crude, a move of more than 11%.
And you're seeing upgrades from Wall Street on potentially where that price can go. Goldman Sachs talking about $90 per barrel on Brent, Jonathan, if Israel was to attack some sort of Iranian oil facilities. Heidi Krabo-Redeker, though, looking at what is the next domino to fall after that. What would Iran then do potentially to some Gulf suppliers in the Middle East? And that is why this is the concern. And I know we're going to be speaking to Ed Yardeni that says this is his big risk potentially of falling into a recession.
Brent crude 79.39 up by 1.7%. WTI up by close to 2. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research on why the Fed might be none and done. Dana Tausi of Tausi Advisory on luxury stocks following stimulus in China. And Greg Dacko of EY on why the next payrolls report is the most important. We begin this hour with markets on hold as a strong September payrolls report puts stocks on a 4-week winning streak. Ed Yardeni of Yardeni Research thinks the Fed can take the rest of the year off. Following Friday's strong September employment report, Federal Funds Futures Markets predicts 5 or 6 rate cuts over the next 12 months. We're predicting none and done for the rest of this year. Ed Yardeni joins us now for more. Ed Yardeni, let's talk about that. Is that one jobs report enough to say they're done for the year?
I think it wasn't just the jobs report. We also had a very strong purchasing managers index for the services economy, and that's where the strength in the economy has been. Initial unemployment claims have remained very low, and so I think there have been actually quite a few numbers. As you know, the Citigroup Economic Surprise Index is positive again, and that's one of the reasons the bond yield is back up. It's a good indicator of the direction of the bond yield.
And if you're right, and they are done, and we reprice this yield curve higher, and we reduce how many interest rate cuts are priced for the next 12 months, how well does this equity market perform, in your opinion?
Well, I think it performs differently. I think we've clearly seen that this bull market has been led by the PE. The valuation multiple has gone up dramatically. Earnings have also been going up, which you wouldn't really have a bull market unless you really had earnings trending higher. And for the S&P 500 that are all-time record high, that's not the case for the mid caps, the small and mid cap S&P 400 and 600. Their earnings have actually been flat. I think the market continues to broaden, but instead of broadening out to the Russell 2000, which would be correlated with interest rates going down, if interest rates stay here, I think it broadens out from the Magnificent 7 to the S&P 493.
Ed, something is different, though, this time for this earnings season than it was in August. In August, we were talking about the high bar that equities had to reach. This time, it's somewhere below 5% that we're expecting earnings growth for this quarter. The bar is certainly lower. What does that mean? Earnings season is about to be upon us. Can this not be the leg of the next bull market rally, whether or not rates are being cut?
Well, it's my preference is exactly what's happening here. I would prefer that the market goes up on earnings from here rather than on valuation. This is not a cheap market. We've got the Buffett ratio. I think it's 2.8. It's at an all-time record high. That's the price to sales ratio. The forward PE for the S&P 500 is about 22, with the Magnificent 7 selling at almost 30, and the rest of the market at 19. So, you know, you're not getting any bargains here, but what the market I think will do is go up on earnings, and we're going to have another quarter where earnings are going to go to a record high in the third quarter.
It has been a market, though, that has been able to rally without the Mag 7, without the mega caps for the most part. In the second half of the year so far, only 2.9% of the rally is attributed to those Mag 7 stocks, according to Bespoke. Ed, is it a market that, even though it is overvalued, at least is more healthy, at least is more broad?
Well, I think it's healthier if the stocks that go up that it broadens out to is the rest of the market, the rest of the S&P 500 beyond the Magnificent 7. But again, you know, those multiples which are at 19 could easily get over 20 here very quickly. And so I think the health of the stock market's going to depend on earnings. I'm a little nervous that everybody's turning so bullish, and all of a sudden everybody's talking about 6,000. I started out the year talking at 5,400 for the S&P 500 by year end, and that was an outlier. I had to raise that to 5,800, and now, you know, that's a meh kind of number. where people are talking about 6,000. So I think there's a little bit, a head of steam here building up that could be disappointed.
Ed, you were ahead of the curve. In your note today, you also talk about, before we get too cocky, you say we should note that we aren't completely ruling out the possibility of a recession. Right. What could trigger a recession for the U.S. economy right now?
Yeah, well, we had been thinking that the economy would surprise to the upside. We've been saying that for 2.5 years, that don't underestimate the economy, don't underestimate the consumer. Looking ahead here, we're thinking that the economy is going to continue to perform quite well. And so I think that's consistent with where the bond yield is. I think interest rates have normalized. I think the Fed really has to reconsider what is the neutral rate, which, by the way, I think is a fairy tale number. It doesn't exist. It's totally a theoretical construct. But all in all, I think the market goes higher on earnings.
Okay, but what about the geopolitics you also have one eye looking at?
Yeah, well, 20%, I don't want to get cocky about this thing as I wrote. I think there is a chance of a recession here, which is a 20% probability in our minds, and it is geopolitically related. I know it's a little bit hard to believe, but you look at the history of geopolitical crises, and more often than not, they've actually been buying opportunities. And the reality is this geopolitical crisis so far really hasn't given anybody a buying opportunity. So there's still a possibility that with this war between Iran and Israel getting to be a more direct confrontation, that there could be a sell-off related to that.
Do you think there's a part of the market then that's a little bit too stretched? Is it an index level call, a sector call? What is it?
Well, I think that it's stretched in terms of valuation, and I think that part of that is because we do have a very passive investment orientation in the marketplace. When people get into the market, more often than not, they're getting into ETFs, and ETFs really don't get very concerned about diversification. If you have an S&P 500 ETF and 30% of that is the Magnificent Seven, that's what you're buying. Whereas managed portfolios might be more conservative, and so that's not enough diversification.
I just want to walk away with the right impression of where you stand, and I don't want to mischaracterize you for the rest of the weekend. Yeah. At the moment, it sounds like you're bearish. Is that fair?
No, I'd say that our view is that we're at the right place in the market relative to valuation and earnings. I think we could get to 6,000. I guess what I'm saying is I hope we don't see a melt up here, because I don't like melt ups. They force me to have to figure out when to tell people to sell. And I think earnings are going to continue to drive the market higher at a slower pace.
So, Ed, if you think that we can continue to move forward, but there's some distortions in the market, it's overvalued, are you in the Cliff Asness camp of AQR, that this is a less efficient market and that these types of mispricings can continue on for longer because of forces like passive management?
I think that's a very good point. I agree with that. But at the end of the day, that's a theoretical notion, and the bottom line is this market going higher? And I think it is going higher. Look, we got $6 trillion sitting in money market mutual funds. They're an all-time record high, and so is the stock market. In other words, the stock market got to a record high without people actually panicking out of money market funds and getting into the stock market. So there's a tremendous amount of liquidity in the system, and there's a lot of buying on a global basis. I would continue to overweight the U.S. on a global portfolio. I think the China thing's kind of running out of steam here, and I think people are going to go back to overweighting the U.S. as kind of the safe haven in the global stock market arena.
Danny, let's finish there. What is it about China that you don't believe in?
Well, they've got some major structural problems. They created, the government created its own mess here with the demographics. They got a very rapidly aging demographic profile. The consumers are stretched. I don't think they're going to be buying additional apartments. So even if they manage to stop the debacle in the property market, that's not going to be a source of economic growth. All in all, it's a government-run, it's an autocratic government running an economy that's done extremely well when they let capitalism flourish. Now they're not.
Ed Giardini, if you had any research, I'd appreciate it, sir. Bullish US assets, just not as bullish as some are right now. Let's put it that way. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Former President Donald Trump is campaigning in key battleground states this week. He was in Wisconsin yesterday for his 4th visit in eight days. And on Saturday, Trump held a rally in Butler, Pennsylvania, the same site where a gunman tried to take his life in July. He was joined on stage by billionaire Elon Musk. The Butler rally was Elon Musk's most prominent moment in the campaign. He publicly endorsed Trump after that assassination attempt in Butler and launched a pro-Trump super PAC in May. Meanwhile, the Wall Street Journal is reporting that Vladimir Putin's, quote, merchant of death is back in the arms business. Victor Bout has returned to work brokering small arms sales to Yemen's Iran-backed militants, according to the Journal. Bout was traded back to Moscow in 2022 in exchange for U.S. basketball star Brittany Griner. And a warning for people who use over-the-counter acne medications. New analysis found that popular treatments were found to contain high levels of benzene, a chemical linked to cancer. Researchers tested more than 100 products and found about a third were contaminated with high levels of benzene. For example, Proactive contained 18 times the amount allowed by the FDA. This putting pressure on the regulator to take action on the products widely used by American teenagers. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, the morning calls, plus Dana Tausi of Tausi Advisory with luxury stocks back in the spotlight on the back of stimulus out of China. That conversation up next. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Citi pushing back. Andrew Holdenhorst was looking for 70 on Friday. We got 254. This is what he has to say. The strong household survey was also entirely due to an abnormally large increase in government employment that we would not expect to repeat. We expect a reversion to weaker dynamics at some point in the next few months. That's the call from Citi this morning. Equity futures right now on the S&P pulling back by 0.4%. Some standout moves in the market worldwide, cross-asset, both in the commodity market and in the bond market. Yields back through 4% on 2s and 10s earlier in the session for the first time since August. In the commodity market, the rally continues. Crude higher by 1.8%. WTI just short of 76 now, 75.74. Time now for some morning calls. First up, Wells Fargo downgrading Amazon to equal weight, saying its positive revision story faces multiple headwinds. That stock is down 1.5%. Next up, Jefferies downgrading Apple to hold, citing overly optimistic expectations for the newest iPhone. We're down another 1% in the pre-market for that name. And finally, Macquarie upgrading Alibaba to outperform, seeing more upside for the China internet sector. That name is up another 2.5%. Let's stick with China. The government's recent stimulus sparking both an equity rally as well as optimism for a shift in consumer spending, benefiting luxury retailers. Dana Tausi of Tausi Advisory Group saying the China stimulus package is the largest since the pandemic. A plan to inject liquidity in the stock market should benefit consumer spending. China is very important to the luxury goods industry, with the highest share at around 31%, followed by the US at just under 25%. Dana's with us around the table. Dana, good morning to you.
Good morning. Thank you for having me.
Thank you for being here. Is it a real deal? Is it the real deal?
Let's see if it's the real deal. Certainly it propelled the stocks when it was announced, and we're going to have sales coming up in just 2 weeks. They're not going to look good. Overall, for most of the luxury players, if sales from China are down nearly 30%, would not be surprising at all.
How weak has North America been for these luxury players as well, and how much is that just to do with Chinese travelers not traveling that much anymore?
Yep. U.S. has been weak for luxury, but not to the extent that you've had China. I mean, it's single-digit weakness for the most part, and overall, the aspirational consumer is what's being impacted. We got the benefit during COVID of stimulus being added to the aspirational consumer that you don't have now. And you're seeing discretionary spend versus essential spend. Essentials is still holding firm. You need newness and innovation to drive demand, but higher prices don't help you in capturing some of that aspirational spend.
When you're looking at the luxury space, it feels very fickle right now and who's doing well, who's not. What's in trend, or maybe in trend, say, in China?
I think overall, you're seeing some of the Chinese luxury brands be in trend, and that's been more important. You're definitely seeing, look at Tiffany, reduce the size of their flagship in Shanghai by around 50%. So it's a time when you're seeing the Chinese go to Japan, given the benefit they're getting from pricing in Japan as compared to China.
Is there a push in China? We've seen this in the mobile phone market. Is there a push in China as well in the retail space, clothing retail, handbags, to have national champions?
Yes, we've heard that. We've heard that everywhere. But you're still going to see, for some brands, you look at Hermes, which is still generating double-digit increases. Some brands are still that lofty. They're doing well. Another one who has a small percentage of their business in China, but it has momentum, Ralph Lauren. Ralph Lauren gets under 10% of their sales from China, but it's really mark to market at some of the upper tier, and it happens to be performing well, given that they're mainly in tier 1 cities.
You've named a couple of names. Let's talk about your top pick. What is it right now?
I'd say overall, when you look at luxury overall, Ralph Lauren is doing very well. If I had to pick from the European luxury players, the benefit in the rebound is going to come from LVMH. The breadth of their portfolio makes them differentiated from everyone else.
So the fashion cycles feel really quick these days, maybe fueled by social media. What is the ability or even the want of some of these companies to try to keep up with them, to try to keep offering new products that capture some of the different trends?
Take a look at what some of these companies are doing. The investment by LVMH in Formula One, what happened with the Olympics, activating experiences with the purchase of discretionary goods, makes you essential and makes you in the cultural mindset.
Those are people who's doing a good job of it. Who's still behind? Who can't keep up?
I think we need Burberry to do better. You need Ferragamo to do better. They're not performing as they had been in the past, and they need to increase their relevancy.
Can we also talk about what's going on stateside when it comes to Thanksgiving and Christmas? I believe we lose 5 shopping days. How bad is that going to be for the retailers?
It is a compressed holiday season. A later Thanksgiving, 5 fewer days. Typically, you still get the majority of your sales the 10 days before Christmas. But look at starting earlier. Look at what's happening this week. Whether it's Amazon Prime Day, Target, and Walmart, everyone's offering deals. Look what's beginning to happen on websites. I do a big look every single week at what's happening. You know what happened this week? More collaborations. Levi's and Beyonce, American Eagle and Timberland. Look what Zara's doing with Stefano Pilati, the former Saint Laurent creative director. So we have ways that brands are trying to say, look at me now. Pricing was less important this past week. Differentiation was more important.
You mentioned Burberry. What do they do to get out of this hole? Because it's a real mess.
It is a real mess. You have a new CEO who just joined, Josh Schulman, who comes from the U.S., brands like Bergdorf Goodman, Capri, and also Coach, where he was before. I think they're going to go back to their heritage. One of the things that luxury brands have, they have items that are iconic. What's Burberry known for? Check and outerwear. Let's see when they do their first sales call what he has to say about his vision.
Are we back to the days where we need to hide the check on the inside of the coat? We back to that again?
Not yet. Let's see, the new store is going to open here on 57th Street shortly. Let's see what it looks like.
Where did it go wrong? Angela Ahrendts ran this company and ran it wonderfully before she was poached by Apple. We had
time when Burberry was losing, Gucci
sounds with
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
60 minutes out from the opening bell. Equity futures right now on the S&P 500 down, lower by 0.4%. One headwind in the bond market, yields higher. It's good news starting to become bad news. We'll get into that. The Russell, no drama. We're down about 0.25% on the Russell 2000. With 1 hour left before the cash open, Danny's got your morning movers.
Yeah, I'm starting out with Pfizer. Starboard, the activist investor, taking a $1 billion stake in the drug company. They're trying to turn it around, according to people familiar. Exactly what they're planning, not quite clear at this moment. Shares are higher by 2.5%. The concern is post-pandemic. They don't have a big blockbuster drug like the COVID vaccine. They're not like their rivals with some sort of obesity and diabetes drug. Apparently, they are approaching former executives to try to bring them back to turn around this company. Again, kind of a Nike playbook. What's old is new. Meanwhile, Rio Tinto is making an approach for Arcadium, both the sides saying so on Monday. Those shares up 33%. It is a lithium play. It's maybe a great opportunity for them. Prices have fallen significantly given that the market is oversupplied with lithium. EV, the demand hasn't been as great.
At a time. CPI will be important on Thursday, but it won't be completely determinative. We get PCE at the end of the month, and then, of course, we get one more jobs report.
Mike, I really want to know what Mickey Bowman says at 1 p.m. Is it going to be a big I told you so?
Well, she did that last week to a certain extent, but the independent bankers, I'm not sure she's going to bring up the macro aspect of it. It's kind of hard to tell. She does a lot of banking speeches because she's the small bank representative on the Fed, and so that one might be aimed more at the bankers. But she does speak later in the week. We might get something.
You spoke to Austin Goolsbee on Friday.
Yes.
He called the report superb. Did you get the sense that they're now leaning more towards really being 50-50 in terms of their dual mandate?
I think they have to be. We'll get another impression from the CPI because essentially inflation causes wages to go up. People see inflation, they ask for higher wages. It doesn't work the other way around. And so just because wages were higher this time doesn't mean we're going to get a big inflation print. So if we don't get a big inflation print, if it comes in sort of as expected, which is just a little bit of a decline, continuing that agonizing crawl towards 2%, then I don't think the Fed has to emphasize it too much, but they will say, we're focused on both sides of the mandate.
CPI coming up on Thursday. With us around the table also, Greg Danko of EY. Greg, it's good to see you.
Good to see you.
What would it take for the Fed to hit pause? What would we need to see?
Well, I certainly think we're going to hear some chatter of a potential pause in terms of Fed policy, but I don't think that's the direction of travel for Fed Chair Powell. I've talked about the fact that he has been a key influencer within the FOMC, and I think his approach is unique, having agnostic optionality, as I've described it. So essentially waiting until the very last minute and being open to potentially being surprised on the upside or on the downside and adjusting monetary policy that way. So that's what led to the 50 basis point rate cut in September. I don't think anyone knows what's going to happen in November.
I agree with you. November 7th is a lifetime away. How important is that November 1 payrolls report going to be? How important would that election be on November 5th?
Unfortunately, I think it's going to be too important. I think there's too much attention to every single data report. I know there's this notion that the Fed is data dependent, not data point dependent, but market's interpretation of how the Fed is reacting to data is very much data point dependent. And you saw it back in August. You're seeing it again today, where you're seeing these massive market reactions to payroll reports that, yes, it was very strong, but there is a reason to be cautious about the overall trajectory of the labor market. Labor demand is still cooling. The hiring rate is at a 10-year low. Hours worked are at their lowest in the post-pandemic era. So the notion that the labor market is reaccelerating somehow, I think, is misguided. We have caution on the parts of employers, and that is what is guiding the economy right now.
If we're overdoing it on just how much importance there is on each data point, how should we then approach CPI this week?
Well, I think what's important to look at is fundamentals. We have to look ahead of the curve, not just at the recent data that looks back at the last few months. We have to think about how inflation fundamentals are evolving. Is there increased pricing sensitivity on the part of consumers? Yes. Is there less pricing power on the part of businesses? Yes. Is there efforts to reduce wage growth? Yes, there's wage growth compression. So you take all of these fundamental drivers of inflationary pressures, and they're still pointing towards disinflation. Will it be bumpy? Yes, we know it's going to be bumpy. And the oil price developments right now are going to add some additional volatility. But the direction of travel of underlying core inflation is still moving in the right direction. And I think that's why you're not hearing from Fed Chair Powell any sense of panic. The economy is still evolving relatively well in terms of the inflation dynamics and the employment dynamics, and they're easing in a preemptive way to kind of rebalance the state of monetary policy.
So then that begs the question, why did they cut by 50 basis points?
I think they really felt like they were behind the curve in terms of having needed to ease back in July. And I think that makes sense. If you're looking at the level of the policy rate right now, it's quite restrictive, right? We don't know where the neutral rate is, but there is evidence in the labor market cooling, in the evolution of inflationary dynamics, that points to a fairly restrictive monetary policy stance. So you need to get back closer to neutral, given where we're seeing the labor market and inflation developments. So that's really the attempt that the Fed was trying to do, and I think that's what Powell was trying to do. He's really the key influencer within the Fed. I put a lot of emphasis on what he's thinking rather than all the other policymakers. As Mike was saying, we have a lot of Fed speeches, but it tends to be just noise.
What changed? Do you think that was a change where Chairman Powell started to take some stronger leadership over this committee?
Yeah.
I think that was a shift, and what's behind it?
I think generally speaking, there were a lot of different views and a lot of data point dependency. Fed Chair Powell is not necessarily a forecaster like Bernanke or Yellen or even Greenspan. He tends to be much more focused on all of the data and is pretty much open to being quite candid as to not necessarily having a fixed view going into a meeting. He has some priors, but not as much as other policymakers. So we were talking about Bowman, for instance. You have a prior that rates needs to stay higher for longer. Well, that's going to be your prior, and no matter how the data evolves, you're going to use the data to confirm your priors. Fed Chair Powell is pretty agnostic when it comes to his view on the direction of travel monetary policy. He mentioned last week that he would see essentially 2 25 basis point rate cuts if the forecast evolved as expected. If it doesn't, if the next jobs report is very strong, he might say, well, let's take a bit more time. If on the contrary, there is more softness, then he might say, well, actually, let's proceed with that 25 basis point rate cut. That agnostic optionality, I think, is the real driver of monetary policy today. And I think it's for the better because data point dependency has run its time.
I was going to say, Greg, you sound different than a lot of people today who are using the last months of data as an excuse to say Powell was wrong, to say he shouldn't have cut 50 basis points and maybe his leadership should be questioned. Would you push back against some of those views then?
Absolutely, because we have to be forward-looking. I mean, it doesn't matter what happened over the last month, to be honest. And we've seen revisions in the payroll reports that are about a third of any monthly print. The upward revision was 72,000. The month prior, the downward revision was 80,000. So you're seeing these massive swings in terms of the underlying data looking back. You have to have more of a forward-looking anchor. I don't say you have to forecast over the next year or 2 years. You have to forecast over the next 3 months. How are inflation fundamentals evolving? How are labor market fundamentals evolving? On both these fronts, you're seeing inflation moving closer to the target, and you're seeing labor market fundamentals pointing to easing labor demand and reduced labor supply absorption. In that environment, you have to be closer to neutral. It's not about being extremely restrictive or extremely loose. It's just about recalibrating monetary policy, to come back to that keyword.
Calm and thoughtful. Greg, appreciate it. Greg Dacko there.
Always a pleasure.
Of EY. The next stop for this market is CPI on Thursday. A range of views around this table. Here's another one. Eric Knudsen of Neuberger Berman joins us now for more. Eric, you heard Greg's view on this situation. We heard from Apollo and Torsten Slok a little bit earlier this morning. Torsten's point is that maybe neutral's got a forehandle. This economy is stronger than this Federal Reserve thinks. It can tolerate higher interest rates. We heard from Ed Yardeni, who said this Federal Reserve is done for 2024. Eric, what's your view on that?
Yeah, I agree with what Greg was just commenting on. In general, the path is towards slowing growth, and the Fed has the latitude to reduce rates from here. Core CPIs in the low 3s, core PCE has a 2 handle. They're a couple percent positive real yields on the Fed policy rate. So they have the latitude to cut 50 last time. We think they cut a couple more times this year. We don't think they go to high twos, low threes in terms of the terminal rate. Maybe they're at 3.25, 3.5 for a terminal rate, but that's still room to go down from here. And this is in the environment of a slowing overall economy, not a recessionary economy. And by the way, China's policy announcements a couple of weeks ago helped with that kind of tail risk, but still a slowing economy, and nominal growth going from 5 to 6% to probably closer to 4% next year. That's going to have some impact on profits and earnings. That's going to have some impact on the labor market. And it's clear that Powell is focused on the labor market.
Does that mean then, Eric, that the animal spirits we saw awakened after the 50 basis point, particularly in the corporate bond market, of spreads and the high yield at 16-year lows, at an LBO machine that's reawakening on Wall Street, willing to issue debt, does that continue at pace, even in the face of stronger data that's had some question whether they can continue with the cuts that they've had?
Yeah, actually, the key question we're asking, and I think investors need to ask, is does the market trade slowing growth or rates relief? And the answer from our perspective is that certain areas of the market will trade slowing growth. And those are the areas that perhaps are the most fully valued. That's where we're concerned about certain areas of credit markets where spreads are very tight, or the most richly valued areas of the equity market, the large cap tech areas. But other areas are ripe to trade some rate relief, particularly on the front end. Those are smaller company stocks. And I agree with Bob Dahl's comments. That's not the junky Russell 2000 money losers. That's quality small and mid cap names that have been squeezed by the rate cycle. That's real estate, which has an opportunity to benefit from some rate relief. So this will be the key differentiator over the next 6 months in our view.
Eric, what are you thinking right now when it comes to the commodity market? You think it remains a useful hedge. Have you gotten in before what is happening geopolitically in the risk premium in the prices?
Yeah, we've added to gold positions in commodities. We had a small overweight in energy. Frankly, that didn't look that bright up until a week or so ago, and we view that really as a geopolitical risk hedge. Gold has been the highest conviction view within commodity markets. But in general, commodity markets, that big question is, will they trade slowing growths or rate relief? As a complex, we're closer to at target in client portfolios in commodities because of concerns about slowing growth. But we like having certain geopolitical risk hedges, including gold and a little bit of extra exposure to energy, given challenges in the Middle East.
Eric, can we just sit on gold? What are the benefits of that? We've seen a series of all-time highs. You're certainly not alone. It's not a lonely call. We've seen a big move so far this year. What are the benefits of maintaining that presence, that position through year-end?
Well, it's got to do with declining the potential for declining real yields. It is, the potential for over time, some softening of the U.S. dollar as you get more kind of convergence of U.S. and other economies. And then ultimately it is that risk hedge for uncertainty and geopolitical shocks. And that's one of the key things we're highlighting right now is that markets are, yes, the broad fundamental setup for markets is overall fairly positive and productive, but you have a lot of liquidity that's sloshing around and a lot of crowded trades. So you see, inordinate moves based on policy announcements, the 21% increase in China, the +4% and 5%, and then down 4% and 5% days in Japan around the LDP election. Gold can be a bit of an anchor to windward in that environment. And frankly, so can bonds in an environment where good news is good news, bad news is bad news. You're seeing it, stocks and bonds are trading uncorrelated, more like the pre-COVID period than what we've seen for the last few years.
Eric, what's the catalyst for a weaker U.S. dollar, given what we're seeing around the world and this idea of U.S. exceptionalism, much better compared to Europe and China?
Yeah, look, we are actually tactically overweight the dollar right now, just given the some of the decline we've seen over the last several months. But on a 12-month horizon, we think that the dollar is likely to soften, and that's based on really more of a convergence view between the U.S. economy, U.S. rates, U.S. policy, inflation, and the rest of the world. You also have the potential for an administration that, while some of their policies may be strengthening for the dollar, really wants a weaker dollar. And we're not calling the election. We're just looking at potential scenarios and how things could play out.
Eric, does China stimulus and kind of a Draghi style, whatever it takes moment change that it also fuels assets outside of the US, not just China, but EM, maybe even Europe and their attractiveness?
In the short term, we acknowledge that the policy announcements make China more attractive now than it was, say, several weeks ago. But what we're still waiting to see is whether there is a true fiscal bazooka to try and address some of the key challenges in terms of consumer confidence and issues in the real estate market. So while the announcements help take out the short-term tail risk around a debt deflationary cycle in China, we're not ready to say that this is going to be a major catalyst for Chinese growth going forward. We'll see more in the coming days. There's going to be a speech from a senior leader tomorrow, but it's going to take several months to see how this unfolds. And then we'll be able to reassess the situation more broadly. But it certainly does take out some of the tail risk concerns around global recession and debt deflation.
Eric, appreciate it. Got to leave it there. Eric Knudsen there, Emily Berger-Berman. Eric, thank you. I'm pleased you brought up Draghi. Biggest lesson from Draghi more than a decade ago was the importance of intent. The ultimate vehicle they came up with, OMT, outright monetary transactions, and never even activated, didn't have to buy a single bond, just showed that he was had the intent to do something. It was enough, it was sufficient. I think what you've seen from the Chinese in the last week or so is the intent to put a floor under growth and say, we'll do what it takes to ultimately hit our 5% GDP target.
That's why it's interesting to hear from people like Eric, even Ed Yardeni, kind of skeptical that the Chinese rally can continue, considering the tone we have heard from China. It's not my word saying that it's Draghi's moment, it's the Draghi whatever it takes. There's a consensus that that is what's happening in China, that they're willing to throw whatever at it. And that's why likely when the market reopens tomorrow, people are saying that it's going to be another rally reignited and maybe it helps the world. So you can kind of pick through the policy details and say, I haven't seen the bazooka yet, but the language is there.
Chinese markets reopening after a one-week holiday tomorrow. Look out for that. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. Hurricane Milton is rapidly intensifying as it heads toward Florida. The storm could reach Category 4 status and spark the largest evacuation in 7 years. Governor Ron DeSantis has declared an emergency in 51 counties and said the entire Florida peninsula on the Gulf side has potential to suffer major effects from storm surge. Milton is expected to make landfall on Wednesday. Meanwhile, Boeing will resume negotiations with its largest union today, this marking the third time the two sides have met since 33,000 workers went on strike on September 13th. The machinists have demanded a 40% pay increase and to have their pensions reinstated. Each day the strike goes on, Boeing loses about $100 million in lost sales. And LeBron James and his son Bronny made NBA history last night when they played together for the first time during a Los Angeles Lakers preseason game against Phoenix. LeBron and Bronny became the first father and son to play in any NBA game at the same time, let alone on the same team. They played just over 4 minutes side by side in the second quarter. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the week ahead. We'll get you the calendar and we'll break things down just a little bit more with Mike McKee from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Tuesday, the trade balance. Wednesday, we'll get some Fed minutes for you. On Thursday, CPI plus another round of jobless claims and some Delta earnings. And on Friday, PPI and new Mitch sentiment together with big bank earnings kicking off with Wells Fargo and JP Morgan. Mike McKee back with us for more. Mike, final word, the Fed speak. How important is the Fed speak when we just heard from Greg Dacko, the only voice that matters is Chairman Powell's?
Oh, I think he's right. We'll get a sense of where the committee is and whether Powell is going to be dragging people one way or another, but we'll have to hear from Powell to get a sense of where he is, and we don't have anything planned from him at the moment.
What's going to take on more importance, Fed speak or CPI or minutes?
I think the minutes will matter a lot because we'll want to know what they were thinking about the trajectory going forward, as Greg was talking about. CPI will obviously be important as a data point pushing one way or another. I think Hurricane Milton could have an impact, not just on politics, but because these two hurricanes could be so big, normally you get a rebuilding boost to GDP, but this could be spread out because it's so large, and that could affect the GDP, shopping data, everything going into November. I mean, nobody in the Asheville area is going out and buying a lot of stuff right now, and that could be true in Tampa, so you could see some impacts on the data going forward.
Also, couldn't the hurricane impact the next jobs report?
It could, certainly. It's going to. Certainly, anybody in western North Carolina, eastern Tennessee has probably not been working, at least on a regular payroll. And then we'll see what happens with with Milton and what it does, because it's going to hit right before the survey week. Survey week is next week for October payrolls.
The chairman alluded to this recently, the importance of the Beige Book. Is it taking on even more importance now for you?
Well, it does, because it's the only thing we get from them. They're always talking to CEOs, business people, and ordinary people in their districts and getting a sense of what is coming ahead. What do the companies see in terms of sales prospects, revenues, and hiring? And they put that into the Beige Book in a very truncated form, but it does give Wall Street and Fed watchers something to go on.
Whose region is this? Is it Bostic? Is it mostly Bostic where the hurricanes hit?
Mostly Bostic, but also Barkin from Richmond.
Okay, so two speakers to watch potentially this week on that issue. Mike, appreciate it. Mike McKee on the latest. Big week ahead, lots of Fed speak, lots of data. Tomorrow, here's the lineup for you. Fantastic lineup right here on Bloomberg Surveillance. We'll speak to Jack Caffrey of JP Morgan, Mohammed Al-Aaron of Queen's College, Cambridge, Tom Porcelli of PGIM, and Mark Cabana of Bank of America. And then this one, 9:30 Eastern Time. Do not miss this. Bramo sitting down for an interview with the JP Morgan Chase chairman and CEO, Jamie Dimon, just a few days before those earnings drop on Friday. Earnings from JP Morgan and Wells Fargo just around the corner. They drop on Friday morning. Before we get there, we've got some work to do. Equity futures this Monday morning, negative 1/3% on the S&P, and a brand new look in the bond market. We've got a lot of fours, a 4% two-year yield, a 4% 10-year yield from New York City this morning. Good morning, big week ahead. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Good Monday morning as we kick off earnings season this week. We have 30 minutes until the start of trading today. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, the fallout from Friday's blowout jobs report is forcing traders to recalibrate expectations. That's all while tensions in the Middle East continue.
As Wall Street firms get set to kick off earnings season, we'll take stock of the tense competition between banks and private credit lenders.
Plus, Pfizer on the rise. Activist investor Starboard takes a $1 billion stake in the pharma giant, trying to turn a spur around. We'll get into all of that and more, but let's take a look at where markets are trading, because we have an interesting pre-bell trade on our hands. You can see stocks down. We had a big roaring finish to Friday after that jobs report that we got, but now the tables have turned. Markets theoretically deciding that was bad news, and part of the reason why is you take a look at what's going on in the bond market. 10-year yields now above 4%, continuing to rise today to the tune of 6 basis points. That has some fears out there, Matt, that maybe this Fed won't actually have to cut at all in November.
Yeah, because the jobs number proved that all systems are go. On the other hand, we're looking at a yield curve that briefly re-inverted this morning. Does that mean a recession is yet to come?
Despite all these moves, that doesn't stop a merger Monday. We are looking at some stocks here. Activist investor Starboard Value reportedly now has nearly $1 billion stake in Pfizer. They're betting on a turnaround plan from the drug maker that has invested billions in M&A. Pfizer now up pre-market almost 3%. Also watching shares of Arcadium Lithium PLC here up almost 36%. It was approached by Rio Tinto in what could be another merger in the mining industry. We'll keep an eye on that. We're also watching Barnes Group agreeing to be taken public by Apollo, which will acquire the tech and space manufacturer for an all-cash deal, valuing the company at $3.6 billion. Barnes now up 2.5%. Also interested in Duckhorn. Wine in the morning. The Napa Valley winemaker will also be taken private by Butterfly for nearly $2 billion, a hefty premium for a wine company worth less than $1 billion in public markets today, Matt.
All right, so a lot going on in stocks today, and to me it seems like we have a little bit of delayed reaction in this market. Remember last month on September 18th when the Fed cut by 50 basis points and the market actually fell. The S&P closed the day down. Of course, the next trading day we were up 1.7%. When you sent me the jobs number on Friday at 8:30 a.m., I was off that day. I thought, wow, that means the Fed's not going to cut, so the market must tank. In fact, the S&P closed higher on Friday.
0.9%.
But futures are down today.
Yes, they are. I just want to talk about what an emotional market this is with such a short memory, because you remember August 2nd, we got a very weak jobs report that spurred a chorus of calls for an emergency Fed rate cut. Now you fast forward 2 months, we got a stronger than expected jobs report. I wouldn't go and call that a blowout necessarily. Suddenly you have traders scrapping rate cut bets altogether, left and right, and raising the very real question in the market right now: does the Fed go at all in November?
Yeah, less than a quarter-point rate cut baked into the market right now, to the point that you're making. But also what I'm interested in, yes, the stock market reversal, we're seeing it today. What we're seeing, though, is an extension of the move in the bond market that we saw on Friday. So my question is, when does the bond market start to impact the stock market? Perhaps this is the start of a trend.
I think we're seeing it today.
If it sticks, right? If
You're
it
already
sticks.
thinking about banks on Friday.
Well, the yield curve inversion would matter to the banks. It means they would make less money. But if rates stay higher, it also could mean they make more net interest income.
All right, let's talk about all of this and more with Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, I think the question of the day really is it better for stocks to have a healthier economy than we expected, but fewer rate cuts, or to have more rate cuts and a pronounced economic slowdown?
To me, this is a sweet spot. This is a great environment for equities. You've got a strong economy. It's slowing, I still think, but it's strong. And you've got a Fed who is still willing to cut rates. We still think there's a 25 basis point cut in November and December, probably slower move through 2025, but it's still a rate cutting cycle backed up by a strong economy. I think it's a great environment.
So slowing, but still strong. And against that backdrop, how do you make heads or tails of what's going on today? You see S&P 500 futures down about 0.5%. Of course, not to extrapolate too much on a single day, but it does seem like the market is taking this good news as bad news.
Oh, you said it before. It's a really dramatic equity market. You've seen that for a couple of months, where it just, the kind of the moves are pretty wild. And I think today there are question marks about whether or not the Fed is going to cut. If it didn't cut, that would certainly be, I think, negative news for the equity market. But we don't think that's the case. I think we're going to hear a lot from Fed speakers this week, provided the inflation report doesn't show a significant pickup in inflation. I mean, that's a big question. But provided it's in line with expectations, and I think you're going to see an equity market which hopefully settles down and we start to move back upwards.
You know, I think about some writing over the weekend from Stuart Kaiser, who we're talking to later in the show, and the point that he made was you could actually see a bounce heading into the election season. Do you think that in the rest of October, given what a strong September we had, there are more room for gains, especially as we start to get those earnings releases? How much upside potential is there?
Yeah, I think there is upside. And as you said, look, this is unusual because into an equity market, into an election, you would typically expect to see some volatility, some concerns. But you've got a global economy which has got a ton of stimulus coming through. We're not just talking about, of course, the US, but you're seeing it around the world, including China. So no, I think that there is room for a melt up into November. The only thing which is restricting it is the fact that valuations are really extended. So I don't think you're going to see the same kind of moves you saw in 2023 or early 24. But certainly this is an upward move for the equity market.
Are valuations extended everywhere, or is it still just the Mag 7? I note that we're going to talk to Natalia Kniziewicz a little bit later, and she's going to tell us that funds have exited their Mag 7 positions, or at least they got out of some of them last week. Is it better to get into, the S&P 493?
Oh, it is. This is, we've seen the big tech trade do well, and we believe in it from a long-term perspective, so it's a strategic asset allocation positioning for us. But if you have a solid economic backdrop coupled up with Fed cuts, it makes sense to look at where else in the market there is a better valuation, which has got a little bit more room for gains. So at this point in time, we're looking outside of the Mag 7, different sectors, different cap sizes, and thinking where are the tactical trades. The question of whether it's extended beyond over the next 6 months, I think, is a bigger one because we still have to see how the economy responds. But certainly over the next 6 months, I think there's a lot of opportunities outside of those Mag 7.
Well, let's talk about, of course, how earnings season factors into that call, that broadening out that you're looking for there, because we hear all the time that rate cuts alone aren't enough when you think of particularly some of the smaller companies in the market struggling under those debt burdens. When you look ahead to the earnings season that kicks off on Friday, of course, with the big banks, but looking beyond that, are you expecting to see results, fundamentals that justify the valuations?
I think we should see some fairly positive numbers. I think expectations, as you'd expect, are starting to come down ahead of the earnings season as exactly what you'd typically see. But I think the rate cutting cycle, it is still an important part of that story because there is some margin pressure especially amongst some of the smaller businesses, those rate cuts will be an additional help as you continue to see those concerns around labor costs, maybe some job uncertainty. Those things are weighing on confidence, and rate cuts certainly help. I don't think we're looking at a bumper season, but this is enough, at least, particularly when valuations for some of them are so cheap, that you could see that push higher.
What sectors do you like going into earnings? Of course, we start with the big banks, but it's a long season ahead, and a lot of it before that election season.
Yeah, absolutely. So we like financials, we like industrials. I think there's a lot of opportunities in there. Broadly speaking, though, wherever you're going, we're still thinking about high quality, right? So it's high quality within your sectors, within your cap sizes. I still think that's key because, fine, we've had a good number on Friday, but the long-term trajectory we still think is a slower economy. So it still makes sense to be focusing on the parts of the market, the companies which do look like they have the good cash buffers, maybe stronger margins, cash balances that can withstand any kind of risks over the coming months.
When you say high quality, I think about staying away from the Russell 2000. I've heard some investors, well, call it kind of junky. What do you think about the smaller caps?
So it's an interesting story, and I think everyone's gone round and round on this one, because typically, a slower economic environment is not great for small caps. We know that. But we just had some pretty good news on Friday, which we think, as I said, it's a slowing economy, but it's still positive growth. And then you've got the rate cuts. But on top of that, there's a valuation story, which is really important right now. Valuations had been, it's moved certainly a fair amount over the summer, but valuations had been so attractive relative to large caps that you just needed a bit of a fundamental push to see the swing. Now, whether or not it's extended beyond December, I think, is a bigger question, but I certainly think there's a tactical opportunity here for that small cap space.
I want to talk a little bit about the rest of the world, too. I want to talk specifically about China. Of course, those markets in mainland China, they reopen tomorrow after a week-long holiday. And you have some people saying that basically all this euphoria that we're seeing, this optimism that we're seeing in the wake of that strong stimulus package, maybe it's looking a little bit overdone. How are you viewing China markets in isolation, but also as they filter through the rest of the world?
Right. I think for China, that's absolutely true. We need to see implementation, we need to see magnitude, and I think we've become accustomed over previous years that you see this wonderful announcement when it comes to implementation. It's really disappointing. So that's always the risk. But I think what we're hearing from policymakers is a real commitment or an acknowledgement that there is an urgency about the situation. And that in itself is positive, which when you couple that up again with cheap valuations, I think it's room for a push. Are you going to see another 20% move in 1 week? I think that's unlikely because you start to now see action and proof coming through. But I think over the coming months, I think there is still some movement for China, and to your next point, how it feeds through to the rest of the world, particularly Asia, so Korea, Taiwan, Thailand, Malaysia. These are all areas that we think we can do well. Europe, I think, is probably another story, a different slight question, maybe some upside for some of the luxury brands. I think European story is a little bit weaker from a fundamentals perspective.
But with all that said, where do you put the marginal dollar? If you had to choose between Chinese equities or U.S. equities at the point where valuations look high, right? They look quite stretched in both regions after the run-up you've recently seen. Where does that extra dollar go?
It's a great question because, as you said, we can talk about the U.S. market looking really extended, but it's not like it's the only market which is looking expensive. But I still think China has still got attractive valuations. It makes sense to maybe to plug it into some segments of the China market, but also other parts of EM which do stand to benefit. So there are opportunities. I think this is a time for global diversification, particularly when you remember that there's a US election on the way, there's a Middle East conflict. Having all your eggs in one basket is probably not your wisest decision.
All right, Seema, hold that thought. You're sticking with us. Let's take a quick check on the markets right now. With about 20 minutes until the bells ring, you can see red on the screen all the way down. The S&P 500 off 0.3%. Same thing, too, if you take a look at the NASDAQ 100 and the Russell 2000, of course, the bond market starting to make itself known to the equity market as traders shred up those rate cut bets. Let's get a look at the stocks moving underneath the surface. We're going to do that with Abigail Doolittle.
Well, with U.S. futures down, as you're pointing out, in the pre-market here, Katie, let's take a look at some of the biggest point drags, including Apple, which of course is one of the biggest point contributors to the S&P 500 and the NASDAQ. We do have Jefferies downgrading shares to a hold from a buy, saying that excitement and optimism around the iPhone 16, well, it's overdone, especially as it has to do with AI. Turning to another big point contributor to the big indexes, the S&P 500, the NASDAQ 100, we do have Amazon down 1.3%. I should note both of these stocks off their lows. This has to do with another downgrade, Wells Fargo cutting shares to an equal weight from an overweight, so essentially, again, a hold from a buy. This ahead of the all-important Prime Day, which starts tomorrow. The analyst over at Wells Fargo thinks that there's lots of headwinds, including that AWS, their cloud unit. It's just cannot all rely on cloud. And then finally, let's end on a bright note here, Shonali. We do have the shares of Wynn popping higher, up 2.2%. The initial gaming data out of Macau for the Golden Week, well, it's positive, so that's one boost. And then we also have Wynn receiving a gaming operating license out of the UAE. That is another reason this stock higher because of all the China stimulus and that Macau reliance. Shonali, these shares up more than 30% over the last 2 weeks or so.
Abigail, thank you for keeping an eye on what's moving under the hood. Now, coming up, 1 year has passed since the major escalation between Hamas and Israel. We're going to have the latest next. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
You'd do anything to keep your family healthy. So, isn't it time that you started thinking about your water? With Aquasana, the contaminants you worry about most are removed. Get clean, healthy water in your home today.
Now up to 50% off at aquasana.com.
With the vision to see what's possible and the grit to make it happen, Morgan Stanley can help create the future only you can see.
Let's get out of high interest to look at what's making headlines around the world. Fighting in the Middle East is escalating after Hamas fired rockets at Israel from Gaza. 1 year has now passed since the Hamas fighters stormed into southern Israel, setting off the chain of turmoil that has engulfed the region ever since. In Israel, 1,200 people were killed and 250 others were taken hostage. Around 100 remain in Gaza. Of course, that's a year ago. Since then, 42,000 Palestinians have been killed and around 2,000 people have been killed in Lebanon by Israel. Hurricane Milton is intensifying its path towards Florida, with the storm expected to reach a Category 4 status. The potential for devastation to Tampa and surrounding areas is already estimated to cause tens of billions of dollars in damage. Milton will be the second major storm to strike Florida in less than 2 weeks and the fifth hurricane to hit the U.S. this year. And gold bars are flying off the shelves at Costco as bullion prices hit fresh record highs. A survey of stores across 46 states revealed that the retailer is struggling to keep gold products stocked. Yes, it actually sells gold bars. The one-stop shop has attracted a new cohort of fresh buyers to the precious metal, even as prices continue to climb up around 30% this year alone. Shonali?
I'm an Indian person, Matt. I grew up with gold bars in my basement. That is safety if you have ever had it.
What's your address?
Keeping that away from you. Anyways, we are back with Principal Asset Management Chief Global Strategist Seema Shah. If you think about last week as a microcosm, you saw the escalation of tensions in the Middle East, and you saw a bid in the bond market. We saw a sell-off after what we saw from the jobs report, but are bonds a haven here given those tensions, those cross currents you're seeing in the market?
I think it is to some extent, right? Now, of course, it's being somewhat dull because there's a whole changing expectations around the Fed. I don't think that 10 years have too much further to go from here. And certainly, if you were to see a continued escalation where you do see some really meaningful deterioration, then I think that safe haven play comes in. I mean, but you just mentioned gold. I mean, that's another one, which I think in this environment, you've got global political tensions and you've got maybe renewed concerns. Some people have renewed concerns about inflation. That is a perfect time for gold.
Shonali, I hear what you're saying about that brief bid that we saw, but you take a look at the 10-year Treasury yield. I mean, it's risen 3 straight weeks in a row by a pretty impressive magnitude, up 22 basis points last week alone. So you mentioned gold, but when it comes to havens, when it comes to hedging this market, I mean, could you just do that through options, or do you think that there's still value in taking yourself entirely away from the equity market for that hedge?
I don't think you want to take yourself away from the equity market. As I said, I think there's a lot of upside to play there. But I think fixed income, particularly core fixed income, has got a really important part to play. You know, I think duration, it's not as attractive as, you know, ideally it would have been, but I think it's an important hedge against maybe some downside economic risks and maybe geopolitical tensions. And I think the front end of the curve actually has come up a little bit too much. I think there's question marks around whether or not the Fed is going to continue to cut rates. I think it will. So that probably means a little bit renewed downward pressure onto that front end, whereas the long end, because we're still looking at a soft landing, maybe has a little bit further to move up, but I don't think it's too much.
But you don't think, I mean, when rates started to drop, the idea that money would flow out of money markets into stocks was one that pretty much every strategist was touting. You know, now that we're back at 4, it feels like my alarm went off, but it's Saturday, so I'm going to go back to bed, right? Shouldn't I just be attracted back to cash?
No, because, and I think this is just about today, because people are saying, right, is the Fed going to continue cutting? I think they will. And if they're cutting, then actually your reinvestment risk of sitting in cash is just growing and growing and growing. This is actually a great opportunity right now, given the sell-off, to get yourself exposed to fixed income, lock in some of those higher yields. So I think there's a lot of it going on with financial plumbing, which is diverting or at least keeping cash in money market funds. But that over time will shift away. And we should see that pushing into risk assets, which will be another tailwind.
I think another really important trade to talk about is the energy trade at this juncture, just because of the way we have seen commodities move on the heels of escalating conflict and the bid we've seen in the energy sector, even on days where no one wanted to buy stocks. Is that sustainable?
I actually think the commodity space, energy, is a really confusing part of the market right now, because it's moved in ways that you wouldn't necessarily expect it to. I mean, even in the early moments of the geopolitical crisis, you were not really seeing oil prices rise because of, you know, considerations around supply. To me, this is a slightly confusing part of the market. I think there's better opportunities outside of commodities.
Yeah, I think a lot of people would agree with you there. Seema, we only have about 30 seconds left with you. What is your highest conviction at this moment, would you say?
I think you want to have increased exposure to equities, but it should be global diversification. There's no one clear segment of the market which is looking attractive with fundamentals as well. So this is the time to spread yourself out, because actually the outlook for global equities is still really positive.
All right, diversify. That's a good note to leave it on. Seema, it's great to see you, especially in person. That is Principal Asset Management Chief Global Strategist Seema Shah. Now, coming up, this wine's got legs. A Napa vineyard is getting bought for nearly $2 billion. We'll have the details next in Social Climbers. This is Bloomberg.
fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
What I thought was a complete life was nowhere near complete. But it is now.
Learn about adopting a teen at adoptuskids.org.
Tuesday, a Bloomberg exclusive with a Wall Street titan. JP Morgan Chairman and CEO Jamie Dimon sits down for an exclusive interview with Bloomberg's Lisa Abramowitz, live from the JP Morgan Techstars Conference in London to discuss the global economy, risks and opportunities around AI, and the U.S. election. Tune in Tuesday at 2:30 UK time, 9:30 Eastern, only on Bloomberg Television. Context changes everything.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Boeing and its union will return to the bargaining table today, resuming negotiations as the strike enters its fourth week. Workers still holding out for better pay and pensions, but each day of the strike costs Boeing an estimated $100 million in lost sales. Next up, Chevron selling its stakes in some oil sands and shale assets to Canadian Natural Resources for $6.5 billion. The all-cash transaction expected to close in the fourth quarter, subject to regulatory approvals. And finally, luxury winemaker Duckhorn announcing it will be acquired by private equity funds managed by Butterfly in an all-cash deal that values the company at $1.95 billion. Quite a premium there. You can see shares absolutely flying right now. And of course, you can follow all the latest company buzz on TRE and Go on your Bloomberg terminal. Quick check on futures, of course, as we count down to those bells. You can see it's red all over, from the S&P 500 to the NASDAQ 100 to your small caps, currently down about 0.3% on the Russell 2000. We'll discuss all of it as we are less than 4 minutes to the opening bell with Stuart Kaiser of Citi. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Moments away from the start of trading, do we really need any more jumbo rate cuts? This is Bloomberg Open Interest. I'm Matt Miller. Take a look at futures now down a third of 1% on the S&P, about 0.5% on the NASDAQ. The concern that the strong jobs number we saw on Friday negates the need for any more serious Fed cutting. In fact, we're no longer even pricing in a full 25 basis points in November. You hear the opening bell. Oracle, Sunny Singh there ringing the bell at the New York Stock Exchange. Over on the NASDAQ, Sanofi ringing the bell. We're going to be talking about a competitor of theirs, Pfizer, getting a $1 billion investment by Starboard a little bit later on. Right now, in terms of the major averages, as we kick off this week, earnings week, Katie Greifeld, what do we see in terms of the moves?
Well, Matt, it's not even jumbo rate cuts. It's do we need any rate cuts at all? Plenty of people asking that question this morning, and you're seeing that question being asked in the markets right now. The S&P 500 currently off by about 0.3%, a little bit more if you take a look at the NASDAQ 100, your big tech average there, and a little bit more even if you take a look at the small caps. The Russell 2000 currently down about 0.4%. The question becomes, what does the driver become? But we'll ask that to Stuart Kaiser in just about a minute. Some stocks to watch here, though. Let's take a look at Apple and Amazon shares, really dragging down overall markets after Apple downgraded by Jefferies over iPhone sales pessimism, while you had Amazon cut by Wells Fargo on cloud growth concerns, rather, Shanali.
Also keeping an eye here on Pfizer, moving up about 2.3% as the market opens. That's as activist investor Starboard Value is betting nearly $1 billion on the drug maker's turnaround plans, even reaching out to former executives for that plan. It has spent more than $65 billion, Pfizer, in acquisitions since 2022. We'll keep an eye on that story for you. And Matt, I know you're watching more M&A.
Yeah, Rio Tinto has approached Arcadium Lithium for a potential takeover as the mining sector turns its attention back to growth. Arcadium is one of the world's largest lithium miners with operations in Argentina, China, Canada, and Australia. So we do see a lot of M&A action from wine to, I guess, rare earth.
Yeah.
Is lithium a rare earth? I don't think.
Rare earth.
I don't know. It's, in any case, you need it for stuff.
Batteries. We'll look into this offline, but let's get now to Citi U.S. Equity Trading Strategy Head Stuart Kaiser joining us on set. Stuart, it's great to see you.
Morning.
I won't ask you about rare earths, but I will ask you about this reaction that we're seeing in the markets. We just had a great conversation with Seamus Shaw, who said, this is a strange reaction. Life is good. You have the Fed cutting into economic strength. This should be a good news day, and yet the arrows are all going down.
Yeah, I agree. It should be a good news day. I think you're still kind of in bull case category. What maybe you're not in is Uber bull case category. You know, an Uber bull case was you're getting the Fed kind of cutting relatively aggressively into a sort of solid to modestly slowing economy. You know, the markets have taken some of those rate cuts away. But like, you know, maybe to Stephen's point, I think big picture, you know, having stronger growth data is much more important than pricing out a couple cuts in our view. So, you know, we would still be relatively positive on the outlook for equity markets here.
You know, you wrote over the weekend that you could actually see an increase in equity markets here, a rise into the election season. SEMA actually even called it a melt up, potentially. So what does that look like and what would drive it?
I mean, what we're driving, I think, is you get a friendly inflation print this week so the Fed can kind of keep gradually getting themselves back towards neutral at a time when, you know, earnings growth and economic growth hold in. So I think you need a sort of inline inflation print on Wednesday, and then the start of earnings season. You just hope that that looks a little bit cleaner than last earnings season. So this is a growth story. There's a growth market we're living in.
So I was actually out on Friday going to my last brother's wedding.
You keep mentioning that.
Well, because the jobs number, I was still like plugged into my Bloomberg, right? Yeah. And when I saw the number 254,000, I thought, wow, I think that's exactly the margin of error, right? I mean, this is such a noisy data set. Is it really a game changer? I mean, can we really say now, oh man, the labor market's super strong, or are we going to see downward revisions the next 2 or 3 months?
Yeah, I wouldn't call it a full game changer, but I think the thing with Friday was you had a strong jobs number, you had positive revisions, and you had the unemployment rate fall. So every sort of metric in the labor market data was positive and supportive. So I think that's what's kind of got people a little bit more convinced. You know, in our view, I think the markets respond to payrolls. That tends to be what we focus on the most, but it does seem like the Fed is much more sort of focused in on the unemployment rate. And to get that unemployment rate back to 4.05%, I think was a big step for them. So not a full game changer, but definitely a flip in sentiment in our view, you know, at least until the next one on November 1st.
Yeah, of course, right before the election too. But Stuart, I'm curious to hear your thoughts on how this raises the stakes, if at all, for that CPI release that we're going to get later in the week. Because one of the things that freaked the bond market out, which Nala, you identified last week, was that rise that we saw above expectations in average hourly earnings. And with that in mind, I mean, this market, these traders have been so content to just sort of ignore inflation, say that's mission accomplished, but maybe not.
Yeah, I mean, I do think the market is trading it as if we're on a downward inflation trend, and you might get some volatility in there, but I think, you know, people will view this as still a downward trending inflation market. To your point, though, after last week's high print, after a strong payrolls, if you were to get an upside surprise, then, you know, maybe the argument there is nominal growth is at a level where the Fed doesn't need to or shouldn't be cutting. So, you know, big picture, I think you're going to need a relatively significant beat for that to happen. But to your point, you know, accumulation of data, you know, 2 in a row plus a strong payrolls report, you know, could get people talking much more in that direction. But hopefully that's not the case. Hopefully we get a friendly print and we just rally.
I hear more about the wages as it pertains to earnings in particular, because if wages are on the rise, that is an input cost. And why wouldn't margins be more constrained in that scenario, especially with potential supply chain constraints here when you're watching what's going on around the globe?
Yeah, look, it's interesting. Coming into the year, that would have been your fundamental downside from an equity perspective, which is nominal growth declines, but wage inflation is positive. So you get this kind of tough issue where your revenue line is slowing, but your wage inflation is rising behind that, and you do get margin pressure. You know, maybe we saw a little bit of that last quarter, but the fact is earnings have just remained strong. So I agree that's a risk. That's sort of your fundamental risk in the background. But I think the market's going to have to see the white of the eyes on that one before they really react to it.
We're waiting to see the whites of the eyes starting on Friday, right? In terms of the big banks kicking off earnings season. Sonali is already preparing. Probably was last week.
The yield curve.
Yeah. So what do you expect from the big banks, and what do you think about, you know, sectors, industries? Where do you like?
Look, I think, you know, banks are going to be important, obviously, kind of set the tone for what they're seeing from a credit risk perspective and on the economy. But look, the earnings season is going to be basically October 24th to November 1st, give or take, which is when you get those large cap, you know, tech stocks reporting. So last quarter, that number was a little bit.
Wait, are you poo-pooing the banks? He's poo-pooing the big banks.
Hey, listen, the yield curve being inverted into today and losing its steepener, I have questions too on how well they can do.
It's an issue. Obviously, I'm not going to get myself in a compliance issue by talking about banks a week ahead of earnings. Look, I think the four takeaways we care about this quarter. Number one is last quarter you had the 493 generate EPS growth for the first time in a year and a half. That's hugely important to the broadening trade. Banks, what are they saying about the economy and credit risk?
Tech is a margin issue, and then really late in earnings, you're going to get an update on consumer spend. So those are going to kind of be the three things to talk about.
That's a good roadmap.
Yeah, and look, I agree. Like the twos tens has become an interesting topic, just because, in our view, once you get out of inversion, the market starts to trade growth. Once you get back into inversion, it becomes a much different game, both for the banks and for cyclicals in the market as well. So twos tens really important, and we'll have to just see how that decides to settle out.
I will say that financials are only 13% of the S&P 500, and if you take a look at what is actually in that sector, it's not a lot of banks, to be honest. So it's a lot of fintech, et cetera. So we'll see. Of course, the big banks matter for what they say about the economy, but
because they're our viewers, right?
That's
our
true.
clients and viewers.
We don't say that out loud.
It's big bank TV.
Well,
in any case,
they matter to the capital markets, I think, here. If you don't have credit being extended to the economy, how quick can these companies really grow on the heels of that, I think, is the main question.
These are all important questions, but just making the point, it's a pretty small slice of the overall market. But before we let you go, of course, you are head of equity derivative strategy as well. And when you take a look at what options markets are braced for, what people are positioned for, what screens out to you right now?
Look, I mean, at this point, you have very little event risk priced in really until the election. And election risk pricing is extremely high. You're at 2.5% type implied move for the S&P 500, almost 4% for small cap. So I think really now that we're past payrolls, the market is really going to start to really narrow in on what's being priced in for election risk and kind of how they want to trade that. You talked about bank earnings. We had a big volatility shock in August. So I think that's one thing kind of under the surface people are going to be taking a look at. Do these banks benefit from that market volatility, or does that become a headwind? But in terms of vol, vol is pretty much calmed down right now. You're trading basically CPI, jobs.
The VIX is at 21, though.
Yeah, but if you look at forward implied volatility, that risk is concentrated in just a couple of days. It's concentrated on Wednesday for inflation, it's concentrated on November 1st, and then it's concentrated in the election. So you're kind of basically it's an appointment only type market. We're going to trade 2 or 3 days for the next month. In between those days, the market's, going to take a little bit of a breather, like Matt did on Friday.
21.65. What's high anymore anyway? Stuart, thank you for joining us. That is Stuart Kaiser, Citi's head of U.S. equity trading strategy. Now coming up, a look at big pharma. Activist investors Starboard seeking a turnaround at Pfizer. We're going to talk about what's up with that next. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
that actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Bloomberg Open Interest. Let's take a quick check on stocks right now. And I wore green. Shonali did too. It's not making any difference in the market, unsurprisingly. The S&P 500 off about 0.3%. And it gets even worse if you go down the list. The big tech index, your NASDAQ 100, off by about 0.5%. Same thing if you take a look at the Russell 2000. Of course, investors questioning the Fed's rate cutting path from here. But let's move on to some of our top calls. The analyst action in focus this morning. We have a lot to get to. First up, Barclays downgrading Netflix to a sell. The analyst says that the company's premium valuation too optimistic, also sees revenue growth slowing from here. Netflix, of course, reports earnings next week. Next up, Jefferies upgrading Coty to a buy. The firm is confident in the beauty company's ability to expand its prestige portfolio, and as the company has less exposure to China and a very attractive valuation. Shares currently up about 5% or so. And finally, we have JP Morgan upgrading Ally Financial to a buy following the recent sell-off. The analyst says that investors should be taking profits on consumer finance stocks and says that Ally reflects the opportunity created amid rapid swings in sentiment, Matt.
All right, now another stock that we're watching, we've been talking about today, is Pfizer. Activist investor Starboard Value is said to have taken a nearly $1 billion stake. A $1 billion stake in the drug maker. Let's discuss, I guess, the potential for a turnaround for Pfizer with Bloomberg's Madison Muller, because Madison, this was, I think, a $300 billion stock at one point, and now it's trading at about half that.
Yeah, and this stake isn't huge, but what we know is that Pfizer is used to being a pharma darling. I mean, during the pandemic, they were really top of their game. We're all used to talking about them, knowing them. Their revenue doubled during the pandemic to $100 billion. And so what we know is that investors are not happy with Pfizer's performance post-pandemic. They've struggled to develop an obesity pill. They've struggled to really find their next big hit. And so they're hoping for a turnaround.
Part of the story that amuses me a lot is that the activists here, Starboard, reached out to former executives, Ian Reed, Frank D'Amelio, two executives known for their buying spree. What is it exactly does he want here, Jeff Smith over at Starboard? Is it more acquisitions? Do we know?
We don't know really yet, but one of the things that we have been hearing is that investors are not happy with Pfizer's M&A strategy in particular. Albert Bourla, who's been Pfizer's CEO for the last few years, a name that many people know, has done a lot of deals, post-pandemic, but so far those deals have not really yielded the results as quickly enough as investors were hoping for.
This is a great full-screen list, by the way, because these are deals that were done under Bourla, right?
Exactly.
Not the predecessors that Shonali says were also acquisitive. This is the problem. They're not yielding any blockbuster drugs.
Right, and I mean, we know the Seagen acquisition, huge acquisition, we do expect that will yield some blockbusters, but not for another few years. It's not really happening as quickly enough as investors had hoped to replace the dwindling revenue from the COVID vaccine and treatment that the demand is just not there for anymore.
Well, shareholders clearly welcoming the news today. Pfizer shares currently up 3.6% in trading. But talk to us a little bit more about the pipeline. You mentioned, of course, their struggles to create a viable obesity drug, try to tap into that craze. But what exactly are they cooking up right now, especially after all those recent acquisitions?
Yeah, I mean, Pfizer has really set its sights on cancer. That is the big thing. I mean, they came out with this big Super Bowl ad, talking all about cancer. They've really tried to rebrand themselves as a cancer company after the pandemic. They've also tried to develop an obesity pill, like we've talked about so many times on the show. Obesity is the next big thing. Pfizer has really struggled with that so far. They do have an obesity pill in development. It's a once daily pill, but analysts are not super hopeful that that's going to be the next big thing, and that's going to be able to compete with all of the other obesity drugs that are in development. They have a migraine drug that they got through the acquisition of Biohaven, but again, that's not a huge blockbuster yet. So really just, I think, that's the big question is like what else in the pipeline is going to get people excited?
And even on M&A, that Seagen deal is one of the top 5 completed deals, but you kind of have to go further back beyond Borla to find anything close to that size. Madison, we thank you so much for your reporting, keeping an eye on all things Pfizer and pharma. Now coming up, we're going to turn to banks versus private credit. Banks are reclaiming debt deals from the world of private credit. We're going to discuss what's going on in our Wall Street beat. This is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's time now for the Wall Street Beat. Big banks set to kick off earnings season at the end of the week, and all eyes will be on competition from private credit. Joining us now is Richard Farley, partner and chair of the leveraged finance group at the law firm Kramer, Levin, Naftalis, and Frankel. One reason that they're watching the private credit kind of diaspora here as it relates to the banks is because of underwriting, deals coming back, and a lot of them have. That is pure fees for the banks. What's the dynamic under the surface?
Well, look, I think it's been viewed too long as a purely competitive dynamic, right? The banks versus the private credit providers, and I think that's going to change going forward. What you need is really a combination of capital and origination capability, and also scale. So I think what we're seeing now is partnerships and joint ventures between large banks and large credit providers. The banks have the origination. They may not be able to put certain loans on their balance sheet for regulatory and other reasons, and the amount of capital going to the private credit space has become absolutely enormous, and they need that origination capability. And obviously we saw last week the joint venture between Apollo and Citibank, which I think is just the first of marriages of this type.
So it sounds like you're looking for more joint partnerships along those lines then.
I think they're going to have to, right? I mean, what choice do you have when you have a client who wants to do an acquisition, but the loan doesn't meet the regulatory guidelines? You're going to wave goodbye and hand them over to a private credit provider, or are you going to try to harvest those fees in part? I think we know the obvious answer.
Right.
But you have to have enough scale and expertise to be able to do that regularly and keep the flow and not be disappointing your client because you've got someone who's going to be, not able in terms of the supply of capital to service those needs. So I think the large players on both the commercial banking side and the private credit side are going to have these arrangements.
We'll weigh in on some recent research that we got from Bank of America. They found that almost $30 billion of private debt has been refinanced through the broadly syndicated loan space across more than 70 deals so far this year. So it feels like maybe banks are starting to take back some share from private credit.
It isn't really taking back. It's really more of where are interest rates, where is the syndicated market demand versus private credit, and it's going to ebb and flow. And when it ebbs, you don't want to be sitting there twiddling your thumbs. You want to have a relationship where you can put that in a private credit space. So I think it's not driven by, okay, how do we get more of these loans that were in private credit back in the syndicated market? You can't control the investor appetite. You can't control rates.
I mean, it's a great point, because when we saw the Apollo City deal, I think I made some ignorant comment to Shanali along the lines of, they have 240,000 employees. They can't even build this in-house, but you're saying that's not really the point.
That's not the issue, right? The point is that the regulators don't want you making certain loans, whereas a private credit absolutely wants those loans. So there's a natural synergy between those relationships.
Explain this to me. Something I don't understand is that you have groups like the Managed Funds Association really pushing these types of deals, and other research posted online from former FDIC Chair Sheila Bair over the weekend saying, look at where the risk is going. It's not in the banks, it's over there. Should you not be more concerned that risk that is not deemed appropriate for banks in this juncture is being held on what's now becoming the balance sheet of insurance companies instead, and pensions?
The people who hold those loans are compensated on the basis of how those loans perform. So I think when your compensation is directly tied to the performance of the loan, I think you're going to do your diligence and be very careful. It isn't like the purchasers of private credit aren't retaining a significant portion of those loans. They are. They're going on the balance sheet. And it isn't like a private equity fund where one grand slam can make up for a few strikeouts. If you get a zero in debt, you've got a major problem.
What do these conversations look like for you under the surface? Because you see merger Monday like today, 2 take privates, multi-billion ones just this morning. How much more are you seeing ahead, and what role do private credit firms play?
I think private credit is going to continue to play an increasing role. I think that once we get this election behind us and hopefully a little more geopolitical stability, I think there's going to be a little more of the animal spirits. I think right now things are still a bit restrained. We do have an interest rate environment that's moving in the right direction, and an economy that seems to be holding up. And Powell looks to be the man of the year if this holds up. So I think everyone's very optimistic, but we've got the next month or two to sort of get through this period of unease. And perhaps longer on the geopolitical issues.
So we have bank earnings kicking off Friday, and I just wonder, in terms of private credit, you have such long experience with these big firms, who are the ones that we should be watching? Like, who are the ones where the private credit earnings are going to stand out?
Yeah, look, I think you want to look at the largest players, right, which in terms of the U.S. banks are going to be J.P. Morgan, Wells, and Citi. I think those four are probably the ones to keep a close eye on in terms of this space. Because when you get into the funding of large leverage buyouts, those are really the big American players. Now, of course, you have the Barclays and the UBSs and the others in terms of European banks, and BMO and RBC in terms of the Canadian banks. In terms of U.S. banks, I think those four are the key to keep your eye on.
And he named firms which all have private credit partnerships.
Yeah.
Fun fact.
All right, exactly. Richard, great having you in.
My
Love
pleasure.
your expertise on this stuff.
Me.
Richard Farley there of Kramer, Levin, Naftalis, and Frankel. Coming up in the next hour, Robinhood's head of investment strategy talks about Wall Street's reluctant reaction to the strong economic readings. Then NASDAQ Entrepreneurial Center's Nicola Corzine on the standout states for new business. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from rainy Orlando, Florida. Alex Steele, Paul Sweeney. We are live here at the Commonwealth National Conference for Financial Advisors in Orlando, Florida. We're scheduled to get out tomorrow afternoon ahead of Hurricane Milton, which is no joke, folks. It's in the Gulf of Mexico, making its way to the west coast of Florida. And good folks down here in Florida, they know what they're doing when it comes to hurricanes, and they're still dealing with the hurricane from just last week, so we'll keep an eye on that. But we are at the Commonwealth National Conference here, Financial Advisors. We're going to talk to a lot of smart people here that are at the conference managing money on behalf of others, and we'll get their thoughts on the markets and kind of what they're looking out for here as they think about 2025. So we got a lot of great guests coming up, and we're also going to stay on top of the news. Mark Champion, Bloomberg opinion columnist, he's going to give us the latest on the Middle East, and that'll be interesting as well. But right now, let's kick things off back in New York. Mr. Johnson.
Hi, Paul and Alex. We are being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest costs. Global turnkey solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. Well, traders have pulled back bets on another jumbo rate cut from the Federal Reserve at the November meeting. This comes after Friday's jobs report. Yeah, that has stocks lower. Bond yields pushing higher right now. The S&P 500 20 points lower. That's down 0.3%, 57.31 on the index. After Friday's record close, the Dow Jones Industrial Average 85 points lower right now, and that is down 0.2%. The Nasdaq 100 108 points lower. That is down 0.5%. Still, Brian Levitt at Invesco sees a positive backdrop for stocks.
Federal Reserve is still too tight given where inflation is in this country. So I would like to see further easing. But the most important thing for investors is we're beyond peak inflation. We're in an easing cycle. Historically, over the next few years, that tends to be very good for markets.
Right now, the S&P 500, only 2 of the 11 major industry groups are higher. That belongs to energy and healthcare, leading the way as oil prices. They inch higher right now as crude oil is higher because of those tensions in the Mideast. Investors also looking ahead to the inflation print. That's out on Thursday, the release of the Consumer Price Index. And among the individual shares on the move, Pfizer climbing. We reported that activist investor Starboard Value had taken a stake of about $1 billion in the firm. Shares of Pfizer right now, they were up 4.3%. As for yields, the 2-year yield right now is right around 4%. The 2-year at up 6 basis points, 3.99%. The 10-year yield, 5 basis points higher. That is at 4.02%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much, John Tucker. The one trip he's probably not bummed to be here for is the one where Hurricane Milton is heading here. But Paul Sweeney, how many steps did you clock yesterday?
16,000 steps yesterday at the Magic Kingdom.
I mean, look at this guy. He says Disney all over him at this point. I'm Alex Steele alongside Paul Sweeney. We are broadcasting to you live from Commonwealth's National Conference for Financial Advisors. I think we've been here for 10 years, which is pretty exciting. Every year for 10 years. We're going to bring you all the great updates with some great guests here over the next hour. In the meantime, let's get more on that Pfizer story. Bailey Lipschultz is back in New York. He's standing by for some of the equity moves. So break down what happened with Pfizer here.
Yeah, Alex, Bloomberg reporting that activist investor Starboard took a $1 billion stake in the company, hoping to turn around what's really been a lagging pharmaceutical company. When you look at it even just on the last 12 months, total return down 5% versus the S&P up and returning 35%. And even if you're saying, well, maybe healthcare has been underperforming, S&P 500 healthcare index returning 19% over the last 12 months. It's really been story for Pfizer where they've struggled to take advantage of the 2020 COVID boom in terms of their vaccine sales. And really, if you look back when I was talking to a trader this morning, even if you go back to the late 90s, he was saying it still has been a company that hasn't really fully delivered on expectations. One thing that did stand out with analysts reacting to the news is that Leerink basically saying, quote, "We do not see low-hanging fruit." And they're saying because of revenue growth constraints over the next 5 years, because of patent cliffs, the fact that they've already started cutting costs and have relatively high debt loads that could only really be reduced by selling down its stake in Haleon, there's still a really tough kind of path forward when I talk to investors and analysts and look at the stock. Again, it's up 4% on the day, best day since May, but really seems to be a tricky picture that the first blush Wall Street reaction is maybe a bit of a head scratcher.
I don't know. The company did such a great job during the pandemic. They get a pass for like ever for me.
Yeah.
Same with Moderna.
Yeah, I was going to say Moderna. I wonder if that's the same there. Speaking of activist investors, it's the same kind of story now for Air Products, yeah?
Yeah. Activist Monday, Alex, I don't know if that has any staying power, but I'm going to try to make it a thing. Air Products ticker APD up 9%.
I think you have to make it a better alliteration there.
I know. Activist AM, I don't know if that really floats. I'm trying to think about. You got anything?
I got nothing.
Got nothing. Oh, well, we'll workshop it before I'm back on in the 11 o'clock hour. APD up 9%, biggest move since August, trading at the highest level since February 2023. Number of analysts upgrading the stock on that Mantle Ridge stake of more than $1 billion in the company. That kind of pencils out to about 1.6% stake. Standing out, though, among sell-side notes or analyst notes, Vertical Research calling it a game changer, noting that the firm is run by CIO Paul Hilal, who has a history of affecting substantial changes in leadership and strategy at companies where it's become involved, basically saying that the firm expects a more intense scrutiny of the issues including CEO succession, capital deployment, and ways to unlock shareholder value. So APD, one of your outperformers this morning, up 8.3%.
Air Products, this is old, basic, diversified. This is a chemical company, right? I'm not sure what you do with a chemical company.
Well, that's the interesting thing, Paul. When you look through some of the sell-side reactions at some of the bigger shops, they're basically saying, APD trades alongside a lot of those chemical baskets. Well, now that you have an activist stake, now that you potentially have management being reworked or pushed to rethink how it operates, maybe that makes it more of a standalone company that can trade on its own story as opposed to just being lumped in with, you know, an ETF or a basket that traders trade.
And before I let you go, we got Wynn Las Vegas Sands also rocking today. What's going on there?
Yeah, U.S. listed companies, Wynn Resorts, Las Vegas Sands, Melco, who operate casinos in Macau, beating expectations, better than expected Macau gross gaming revenue for that Golden Week holiday, which began back on October 1st. Really interesting stuff from JP Morgan, calling out that their checks into gross gaming revenue for the first 6 days of October imply a 30% year-over-year jump, and that this is the best stretch since 2019 for that October Golden Week. Also, Wynn Resorts getting a commercial gaming operator's license in the UAE, so a bit of good news kind of leaning into each other. It'll be interesting, too, to see how some of those economic implementations over in China could impact gambling and people making the trip over to Macau.
I tell you what, if you're a fan of the Vegas Strip like I am, going to Macau is just amazing. They did a phenomenal job in Macau, and they got like, you know, 1.6 billion people live within, you know, 15 minutes of Macau in China. So it's a potential there for just incredible growth there. So, and Wynn and Sands, they're all there in size. So, all right, Bailey, thanks so much for joining us. Really appreciate that. Bailey Lipschultz gave us the latest on the markets. Of course, we need to get back to what's happening in the Middle East. It does not seem to be any lessening of the efforts and operations in that part of the world. Mark Champion joins us. He's a Bloomberg opinion columnist. He's got a column out today. Middle East transformation must start with Israel. Mark, tell us what you mean by Israel really has to be leading any kind of change there.
Well, I mean, the point I really wanted to make was that, you know, Prime Minister Benjamin Netanyahu has been criticized a lot for not putting out a strategy to, you know, sort of make sense of all of the military action and create a sort of longer-term path so that we can see, you know, how to get out of the war and into some kind of security and peace. So, you know, he went to the UN and he said, I do have a strategy and I do have a, you know, a long-term vision. And he called it the sort of the blessed scenario, but it's one in which, you know, Israel becomes a kind of catalyst for the region with its economy, which is incredibly strong and sort of technologically advanced. You know, there are connections, you know, through pipelines and railways, etc., all the way through Israel to Europe from Saudi Arabia, etc. You know, I was just trying to make the point, really, that for that to happen, he's right that there's no room for Hamas and Hezbollah and for the whole axis of resistance that is committed and exists in order to get rid of the state of Israel. But he has a problem at home, and that problem is that there are extremists in his own cabinet whose language and, you know, kind of ideas about, you know, the future of Israel are very similar in the way that they don't allow for any kind of compromise, any room for the other side, in particular the Palestinians. So it's trying to sort of make that point and to say, you know, really, if you want that sort of, you know, secure, prosperous future where Israel is accepted and normalized within, you know, the Middle East, then you really have to start at home, and you have to start, you know, not just saying the Saudis are on our side, but, you know, listening to the Saudis when they say we want to be, but there has to be some sort of vision for how we get out of this.
Yeah, and Mark, you kind of make that distinction between strategy versus military force, right? And I'm just wondering, where do you think Prime Minister Benjamin Netanyahu stands on that spectrum of military on one side and then strategy on the other?
Well, so far it's been all military. And, you know, it's not that I'm saying that, you know, I'm not one of these people who sort of believes that Israel sort of, you know, turned the other cheek after, you know, the appalling events of exactly a year ago today. They had to go in and deal with Hamas. They are dealing with Hamas. You know, there are always questions, though, about how you do that and how you, you know, how you frame that in such a way that you can get people on your side, you know, whether it's, you know, Palestinians who don't particularly like Hamas, and there's a lot of those in Gaza, more than in the West Bank, for example, where they don't actually live under Hamas. You could say the same in Lebanon, where a majority of the population is not Shiite, does not like Hezbollah, does not want its country to be used as a platform for Iran to, conduct its foreign policy with Israel. You can talk about the Iranians too, where a majority of the population doesn't like their regime or want their regime. There's scope here for a different kind of Middle East. It's just extremely difficult to get to, and it can't just be done with weapons alone. Weapons can, actually open a path, but they can't get you to the other side, to a place of kind of peace and security.
So, Mark, to that point, does Prime Minister Netanyahu, does he have the political capital? Does he have the support of the people to play this long game that you're talking about?
Well, I think he would if he wanted to sell it. It's very interesting when, opinion polls are done in Israel. There's a couple of institutes that have done polls. And when you ask the sort of bold question, do you want a two-state solution with a Palestinian state, there's a majority against. When you ask the question, do you want a two-state solution as part of a deal with Saudi Arabia, with the U.S., and that would create this sort of secure environment and a multinational force in Gaza to create a transition there. When you put it as part of a package where people can understand how it might actually work, for their benefit, then the numbers change quite dramatically, and you get a majority in favor. So I think that it's as always, it's a question of what you sell, how you explain things, and I think it's a choice on Netanyahu's part to not go down that road. And there are understandable reasons in terms of just pure power politics, because part of his cabinet has told him very clearly that if he does make any sorts of noises about a two-state solution or a compromise, they will collapse the government.
So if we look forward, and if we wanted to see some kind of pivot from Netanyahu or some rhetoric that may indicate some kind of change or subtle shift, how would that be communicated?
Well, I think what you would start to see, so the main message that I think people outside Israel may not understand quite as well, but within Israel, what he's doing now in Lebanon and and in dealing with Iran directly, that is extremely popular. Iranians, I'm so sorry, Israelis are convinced, and with good reason, that Iran has been building up a kind of noose around their country, and that this is all very calculated and extremely hostile, and they have to do something about it. So the fact that they see Netanyahu now doing something about that, I think that is very popular. But you could, he certainly could sell that by, at the same time as he's going after Iran, he could organize a ceasefire in Gaza that would get the hostages out, that would start to sort of create some kind of scope there to create a more political path and to start building on that. So it is imaginable. It's just a choice that Netanyahu at the moment does not want to make, and I can't see any sign of him making that change anytime soon, especially when he has people in his government who are absolutely opposed to it.
Right. All right, Mark, thank you very much. We really appreciate getting a few minutes of your time. Mark Champion, a Bloomberg opinion columnist, giving us the latest on the Middle East and maybe what might be some next steps there, but a very difficult situation, a fluid situation. Hey, folks, tomorrow at 9:30 a.m. Wall Street time, J.P. Morgan Chairman and CEO Jamie Dimon, he's going to sit down for an exclusive interview with Bloomberg's Lisa Abramowitz at the J.P. Morgan Techstars Conference in London. The pair will be discussing global markets, tech investments, risks and opportunities within the world of AI, the global economy, and the U.S. election. So expansive list of topics to discuss. We're going to take that live tomorrow morning. Bloomberg Surveillance will be simulcast with radio and television. So stay tuned for that. That's going to be
now remember,
Good stuff.
Earnings are Friday.
Earnings are Friday.
Their earnings are Friday, so we're not going to get any sneak peeks.
No? Okay. All right.
But,
Lisa will try. I'm sure Lisa will
she'll try.
She'll try. But again, you're right. That kicks off the earnings season in earnest Friday with J.P. Morgan. Alex Steele and I, we're here in Orlando, Florida, Commonwealth National Conference. Trap Kloman, President and Chief Operating Officer, Commonwealth Financial Network, joins us in just several moments to discuss how Commonwealth has grown and evolved as an industry-leading RIA, so registered investment advisors, a growing source of capital management for a lot of individuals going forward. So we'll get the latest from Mr. Kloman. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash, still feeling the impact of the better-than-expected jobs report on Friday. Stocks are lower, yields, they're higher. Traders pulling back from bets on another 50 basis point rate cut for the Fed. The next big data point, that's going to come later this week with the release of the Consumer Price Index. We get that Thursday. Sources are telling Bloomberg activist investors Starboard Value taking a stake of about $1 billion in Pfizer and seeking to begin a turnaround of the struggling pharmaceuticals giant. Right now, 9 of the 11 major industry groups in the S&P 500 are lower. The biggest drag that's coming from consumer discretionary, and that's where you're going to find shares of Amazon. Wells Fargo is cutting the recommendation of the e-commerce and cloud computing giant to equal weight from overweight. Well, they say the company faces multiple headwinds, and shares of Amazon right now, they are lower, down 2.8%. And as we look at the Dow Jones Industrial Average after Friday's record close, right now down 100 points. That's a decline of 0.2%. We're at 42,253 on the index. The S&P 500 15 points lower. That is down 0.3%. And right now the Nasdaq 167 points lower. That is down 0.3%. The 2-year yield 7 basis points higher, right at 399. Well, we'll say 4%, just crossing over that. The 10-year yield also 5 basis points higher. That is at 4.02%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Really appreciate that. Paul Sweeney and I, we are live from the Commonwealth National Conference for Financial Advisors right here in Orlando, Florida. We will be back and taken off before the hurricane hits, though, so there is that. The theme for this year is The Future is Now, and that mission is to help advisors build a blueprint for their future and empower advisors to navigate business transitions. And this is the 10th year that Bloomberg Radio has broadcast live from Commonwealth's National Conference, so that's pretty cool. Joining us now is Trap Plomin, President and COO of Commonwealth. First of all, thanks for having us. 10 years feels like a milestone.
It's terrific.
Did you get us anything for that?
Yes, I have some swag right over here. But no, thank you for all your support and coming.
So walk us through The Future is Now. What does that mean this year at the conference?
Yeah, one of the things is Commonwealth works to support so many advisors who are really small business owners. One of the things you have to do, absolutely, is be thinking forward and constantly navigating an increasingly complex industry with regulation, with technology. And if you're just focused on the next quarter, the next year, you're going to fall behind. So the future is now. You really need to be looking forward, and it's our responsibility, and it's one of the things that we enjoy doing is helping advisors think forward and start preparing now for the future.
Trap, let's say I'm an advisor at a wirehouse, a Smith Barney or Merrill Lynch. What's my thought process when I think about leaving the mothership and kind of going on my own and being a registered independent advisor? What's the thought process there?
Yeah, I think there's a lot of different reasons, but I think 3 that stand out and we commonly hear is, one is you get to build your own brand. You build in your community and you're known for what you want to stand for. 2 is just the greater independence to make your own decisions and not necessarily have to follow the lead of a larger employer who has many different conflicts and objectives and priorities. And 3rd, and probably most importantly, is you're now building value in your own business that you can monetize. And so as an employee, oftentimes, you leave and you get the gold watch. Here you're building incredible value that you can leave to the next generation or sell. And we're seeing the values of these independent businesses increase dramatically over the last couple of years, and I think that's here to stay.
Why? So why is this increasing so much in such a small amount of time, and how do you see that playing out?
Yeah, I actually think the businesses were chronically undervalued historically. People didn't realize, as there's been the transition from brokerage business, which obviously is commission-based and it's sale to sale, our advisors are over 90% fee-based, and many are 100% fee-based as an RIA or fee-only. And when you have that recurring revenue stream and you're doing more than just investment management, you're doing financial planning and building relationships with clients that are deep and sticky, that now then has value versus something that previously was transactional. So as we've seen the growth in fee-based business, that has exponentially increased the value of those businesses and gives them something to transition.
So when you meet with your financial advisors at an event like this, Trap, what do you hear most from them? What do they need right now?
Sure. Right now it's weather advice.
Yes.
Well, there's that. For those of you wondering, it is cloudy, rainy, not too much wind yet.
No, not at all.
Yeah.
I think we're in good shape. But it's an array of needs, and I think one of the strengths of a community like Commonwealth is we have fantastic advisors who are willing to share with each other. And so they're always, someone's already been there, done that. So no one needs to reinvent the wheel. In Commonwealth, we can play a great role in bringing the best practices together to unlock them for advisors. So for a wide variety, it's how do you scale your business and get to the next level? How do you add and attract new advisors and train them? How do you take your technology, your internal infrastructure stack, adopt AI? It's an array of challenges. One of the most fascinating things that has impressed me is so many advisors are like, where can I find the next client? At Commonwealth, we never hear that. They grow so incredibly fast through referrals. They're coming to us, how can I find the next advisor to keep up with the growth that we're seeing? And as you all know, as businesses are growing and scaling, you have to change your processes, evolve, get more administrative support. So we really help them, not just as a BD or an RIA doing investment management, we're helping them run small businesses. And that's really the central theme we're seeing.
How long do you think that growth can continue for, right? Because in essence, people made more money. The wages went up. We had the COVID stimulus, right? So they needed financial advisors, right? And you have a huge amount of equity within the stock market for regular individuals. At some point, does that max out? And if we had like a huge drawdown or some exogenous event, those small businesses get real small.
Yeah, I actually, in looking at all the different factors that can drive that activity, we're still continuing to see growth in the population, growth in savings overall, if you will. So I think the demand for financial advice is actually only going to improve. And there was some concerns with the advancement of AI and what could the impact of that be on many industries. But the reality is financial advice is not just, again, investment management. It's caring for people on a topic that can often be insecure and stressful. So, the most successful financial advisors are the ones who are really great at human relationships and caring for people through, very challenging times. And so I feel we have great tailwinds behind us, and we'll continue to see growth in this industry, not just in Commonwealth.
Well, one of my offspring actually did follow me in my footsteps in financial services. He works for a financial services firm, and his firm says that their clients are really going to need them over the next 20 to 30 years because they have this massive wealth transfer from my generation to the next. How do you guys frame that topic for your advisors?
Yeah, no, that's absolutely accurate, and we have hundreds of breakout sessions here, and many are on that exact topic. And the wealth transfer between insurance, trust and estate, and taxation is very complex, and it's obviously there's a lot of emotion and people behind it. And so it is starting early in the planning process. And one of the things we have found and highly recommend and work with our advisors on is for whoever is managing the wealth or controls the wealth, if you will, is to start engaging with the next generation now. And really bring them into the planning and the reasons behind it. One of the most powerful things you can do, people always hear and understand, what is happening, but why is this happening? And so we have our financial advisors really engage in that wealth transfer early on to really explain that part of it and help all aspects of the family, not just represent one side and turn it into two people on the other sides of the table. We want to bring everyone to the same side of the table.
This is just curiosity, but how much is the conversation also revolving around retirement? Not for, say, me and Paul, but for, like, our kids. Like, who thinks that anyone's really going to have Social Security in 40 years, right? How much is that conversation evolving as the fiscal deficit continues to balloon out?
Yeah, I worry about that for myself, and I have 3 daughters who I don't even talk about Social Security because I don't
think they're going to have some, or like you don't want to rely on it. Yeah, I
you
get
certainly
that.
don't want to plan for it. Think of that as a bonus, not as the foundation. And so, certainly one of the big things is, in thinking about retirement, is if you quickly put the Social Security in that perspective, what actually becomes a much more exciting discussion we're seeing more in this day and age is people firmly want to keep working and extend their careers, but doing something they're passionate about and that they love. And so often it's really about that second career. At what point can you make that transition from where you're building wealth and focused on that in your family to where you're focused on yourself and your spouse or the people you care about and doing something you're passionate about? And so it's less about retirement, and it's more and more, it's still a key part, but it's more and more too about what's that second career, and that really changes the retirement portfolio. It's pretty cool.
It's radiant.
Yeah, I was going to say, is this it for you, Paul? Exactly. Is this the moment?
Exactly. Talent. How do you attract and retain talent? And maybe even how do your advisors attract and retain talent?
Yeah, it's an ongoing challenge, and it's one of the things when you're running a small business, as the advisors are. They're not just financial advisors; they're entrepreneurs, and that's a talent and skill that they need. And so certainly they can work with us to help them with that. But we're in all 50 states, and they're in their local communities. So one of the cool things we've done here is, historically, no one's going to trust the 20-something to manage their portfolio. It was tough to break into the business. That's changed with financial planning and a lot of the technology that's come to the space. And so a lot of universities across the country have certified financial planning programs, and they come out accredited, and they can come join an office and do a lot of the investment planning and run the work, and then join in the advisor meetings. And so as we think about attracting and retaining talent, there's a growing pipeline. So in the past, the employee models used to train people cold. Now they're coming out of college prepared and can make a difference.
I have like about a minute left, but are the people who are going to the wealth advisors, are they getting younger and younger, or are they still older and older?
We've seen it overall hold steady as we look at the average age and demographics, which overall we see as promising. Certainly people are getting older, but that means more people are coming with wealth. And so yes, people are addicted to their phones and are comfortable with apps, but once your wealth gets to a certain level, you become a little bit more risk averse in terms of owning that responsibility. And frankly, when you're in a relationship managing wealth together, you don't want to be the one solely responsible if things go sideways. You want to be with your partner aligned on your interest and have someone supporting both of you. So I think we're great with the wealth transfer and next generation coming in and trusting financial advisors.
Trap, thanks so much for joining us. Really appreciate it. Thanks for hosting us again, 10 years running. We appreciate that. Trap Kloman, he's the president, chief operating officer of Commonwealth Financial Network. We're down here at their national conference here in Orlando. This place is massive.
Oh, massive.
I mean, this is like Vegas big.
You could clock like 16,000 steps just walking around the hotel. I don't think you needed to go to Disney for that.
No, and it's awesome. It's a great facility here, the Marriott. Just off property, but again, over at the park, what I noticed is there is nobody better than taking money out of your pocket than the Walt Disney Company.
Oh,
it is
my God.
Amazing.
Did you get the Fast Pass thing?
Karen took care of everything. I just followed. I tagged along with her. But it's just, and nobody moves people around more efficiently than Walt Disney Company.
Make it as easy as possible to spend money.
And if you got a drink in your hand, boy, I wish there was a waste basket. You just turn to the right, there's the waste basket. They think of everything. I don't know how they do it. So we're here at Orlando with the Commonwealth National Conference. We're going to have more coming up, some more great speakers. This is
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Bonds have dropped in price, extending a plunge from late last week following that surprisingly robust September payrolls data. The yields on the 2- and 10-year treasuries right around 4%. We haven't seen these levels since August, and that has stocks lower. After Friday's bang-up jobs report, Neil Richardson, the chief economist at ADP, says the Fed actually needs to communicate exactly what's going on here.
We've gone from 2 scenarios, soft landing to hard landing, to 3 scenarios, which is no landing. That is not a great place to make decisions. The Fed could play a role providing that clarity, showing that, look, we are landing this plane and we're landing in a really great place for the economy.
Right now, the S&P 500, 17 points lower. That's down 0.3%, 57.33 on the index. The Dow Jones Industrial Average is down 156 points. The Nasdaq 100 down just about 70 points. That's a decline of 0.4%. Casino stocks, they're gaining after Wynn Resorts received a commercial gaming operator's license in the United Arab Emirates. Next thing investors are going to focus on, we'll get the Consumer Price Index that comes out Thursday, and then J.P. Morgan, Wells Fargo, they're kicking off earnings season for the big Wall Street banks, and that is on Friday. 2-year yield right now, just about 7 basis points higher, 3.99. The 10-year yield, 5 basis points higher, that is at 4.01%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much. Thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. Sweeney, we are live from Orlando, broadcasting from the Commonwealth National Conference for Financial Advisors. The topic is the future is now. And this is the 10th year that Bloomberg Radio has broadcasted live from this conference. Very much looking forward to all the conversations we are going to have today. Let's kick it off now with Norman Grant, Managing Director of Grant Capital. Norman, thanks for stopping in. Good to chat with you.
Absolutely. Thanks for having me.
So, the narrative in the broader market still, after we get this jobs report on Friday that was quite good, is that we still are in a U.S. exceptionalism scenario where stocks can still beat bonds, that this is kind of the narrative for the medium term. How do you guys look at it?
Yeah, we think that it's oftentimes really difficult to tell where we are in the cycle, and it seems like the Fed is doing a remarkable job of, creating this soft landing. We came into this year thinking that things were going to be very tumultuous. There were a lot of my clients were, very concerned, thinking that it was going to be a really challenging year. But I think it shows that how resilient the United States economy is. And they've done a brilliant job of navigating, I think, the interest rates. It's been pretty challenging for some families. I think there's a dichotomy out there. I think if you're a family of modest means, it's been pretty tough for you. It's been pretty tough for you, not just this year, but for a few years. And I think if you're, you've got some means, then things have been pretty well for you, if you've owned assets. Yep. So it's been quite interesting on that front. But jobs are hanging in there. We're still at pretty low levels of unemployment, and things appear to be holding up quite well, and the Fed seems to be navigating this pretty good.
What's a typical client for Grant Capital, and what do they need from you the most?
Yeah, so a typical client for us is, our really big jam is to really think about super high net worth clients like Jeff Bezos, Mark Zuckerberg. And what we like to do is drive those services, that white glove service, all the way down to clients, who are, let's say, somewhere around, 500,000, on the low end, and I would say maybe up to about 2.5 million. That's our sweet spot of where we normally like to engage clients. But we're very, very big around holistic, comprehensive planning. That's where Commonwealth, our firm really supports us well with a lot of great services that we can drive. We also run a very unique investment model as well that tends to be quantitative based to protect to the downside. And then lastly, the thing that we like to be known for is delivering exceptional client service. We feel that leading up to the pandemic, client service was lacking. During the pandemic, it became almost non-existent. A lot of people gave up on client service. And so we really try to rally around that and make that a big part of our practice of what we deliver for clients. So families and then also businesses.
Okay.
We help companies with helping them optimize and strategize their cash flow. We help them think differently about what they can do with their capital. So we do a lot of really exciting things with businesses, yeah.
First of all, I love that you said that's our jam, because that's how I roll. So
All
yeah,
right.
I appreciate that. So when you're talking your jam to small businesses, I'm curious as to what are their questions and how do they differ from, say, the guy making $1 million or the guy making 500,000?
Businesses are first and foremost, it's about cash flow. And cash flow, budgeting.
You're going to say munis? Because this guy loves munis
right.
over here. Okay, go ahead.
In a high-tax state.
Yeah, obviously, munis, definitely are very important to high net worth families, but also to businesses as well. But cash flow is a very critical component for them. And it's something that keeps, a lot of the leadership teams of businesses up at night of how they're managing their capital. Are they really optimizing it? They're always thinking about their short-term plans, intermediate plans, long-term plans. How do they deploy this capital? How conservative should they be with it? And so that's where we can really, come along them, be with them every step of the way, helping them understand how they can optimize both their short, intermediate, and long-term, capital.
When I first started coming to these events, I was surprised that I thought most RIAs were pretty vanilla in the sense that stocks, bonds. I was surprised that a lot of these RIAs, because of their clients wanted, they want alternative investments in their portfolio. I was surprised that not only did they think about alternatives, but maybe the allocation to alternatives. How do you guys think about alternatives, whether it's private equity, private credit, hedge funds, that kind of thing?
Yeah, you got to have it.
Yep.
You got to have it.
How much of it do you have to have?
I think that, for especially, a lot of our clients, I think it definitely deserves, if nothing else, a conversation with clients to let them know that we do have a broad breadth of alternatives available to them, whether it's private equity, credit, lending solutions. There's so many things in the alternative space, and it's a pretty hot topic nowadays as well. And so I love that about Commonwealth is that we continue to offer a pretty robust offering in the alternative space. It's definitely something that a lot of high net worth clients talk about. It's something that businesses talk about. And it's definitely something that I think deserves a place in the portfolio. How much? 5, 10, 15? I definitely don't think I've heard that some family offices are as high as 50% alternatives. So it's definitely garnering a lot of attention and a lot of adoption.
Is it more private credit? Is it private equity? Is it just like a lump thing?
Well, private credit has certainly been extremely hot lately.
Are there a lot of good products available to you guys?
Absolutely.
Okay.
Absolutely. We have quite a few of the major players in the space that are on our platform that we can offer clients. And it's growing and growing every day. In fact, we actually have a pretty big partner, iCapital, who is on our platform, and they tend to be a central hub for a lot of our alternatives. But yeah, you got to be in this space. You got to be educated up on it. It's an exciting space with a lot of really great offerings. And I like to say there's a democratizing of it, where it used to be just for that really high net worth client, but Commonwealth is doing some pretty interesting things where they're really getting those the entry points down to make it a lot more accessible by a lot more of the clients.
Norman, thanks so much for joining us. Really appreciate it. Folks on the radio, you can't see it, but Norman is sporting his West Point sweater, class of '93. He served 5 years active duty after graduating from West Point, so we thank him for his service. Norman Grant, he's a managing director at Grant Capital, giving us his thoughts on these markets and on serving investors here. Coming up, we're going to have Matt Palazzola. He's the insurance analyst at Bloomberg Intelligence. Yes, we only talk to him, it seems like, when there's a hurricane coming, but he's going to join us here and give us some thoughts about this new hurricane coming in towards Florida, what it means for the insurance industry and how the coverage will be, and maybe what the insured losses will be. And kind of what we've learned, I think, from all these hurricanes is there are insured losses, but then there are a lot of uninsured losses, and that's really where the pain gets a lot of folks. So we're going to talk to Matt Palazzola on that, get his thoughts on that. And of course, we can provide in some on-the-ground reporting.
We got on-the-ground reporting. Although currently in Orlando, we got nothing. If we were in Tampa, maybe that would be different. Could see the largest evacuation there.
And people are still at the parks. I was there yesterday. People were there. You know, hurricane be damned. They're out there going to see Mickey Mouse. And all
Maybe I go later. Maybe I go later.
I think you go later.
Yeah,
you
maybe
got
go later.
to go. S&P 500 off 20 points, Dow off 133, NASDAQ off 77. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney. We are live in Orlando, Florida, Commonwealth National Conference for Financial Advisors. It's raining here, but apparently we have a hurricane on the way. It's out in the, I guess, the Gulf of Mexico, but making its way to the west coast of Florida. It's supposed to hit here on the coast, I think, that Wednesday morning is kind of what they're saying at some point. So, but both Alex and I were scheduled to blow out of here tomorrow afternoon, so we should be okay. And the people here, they are used to these hurricanes, but they've had a really tough couple of weeks here up at the Bend up in northern Florida and now here on the west coast. So let's kind of put some numbers around it from an insurance perspective. And Matt Palazzola, he does that for us. He's the insurance analyst for Bloomberg Intelligence. Hey, Matt, can you just frame out what the last week or two for hurricanes and this one coming up to hit the coast, what are the numbers around these things? Because they seem pretty big here.
Yeah, so what we knew was going to happen was with Helene, the losses were mostly are going to be uninsured. So storm surge and flooding is not really a covered peril by homeowners insurance. So you're going to see a larger than normal divergence between insured and uninsured losses with Hurricane Helene. We knew this was going to be a bad hurricane season. It wasn't actually living up to it until like the past week or so. So now we've got Hurricane Milton in the Gulf. It's Category 4. It will probably hear worse news before better. So it will probably strengthen to a Category 5. What's going to happen is it's going to hit a bunch of wind shear before it makes landfall. And that will actually lower the intensity of it. So right now, the National Hurricane Center is still saying major hurricane, which is Category 3 or above. So it should be 3 when it makes the landfall. And I would just say one thing. On the forecast, you look at the National Hurricane Center website, and there's a cone on there, and they call that the cone of uncertainty. And that cone goes across the whole Florida West Coast at this point. So it could be almost anywhere. The midpoint is that Tampa region, which is really a worst case for insurance companies, but that's where we're at now. So there's significant uncertainty over the next 2 days. And like you said, Paul, probably Wednesday morning where we have a landfall.
Yeah, that was when my flight was supposed to take off, so we changed that. But to your point, Milton rapidly intensified into a Category 4 storm. That happened around 9 o'clock, and then now at about 11 o'clock, the National Hurricane continues to rapidly intensify. So worse before we get any kind of better news. I keep hearing that if the storm goes a little north versus a little south, little north is more catastrophic, little south would be better. What does that mean?
So the main thing with hurricanes is the location, right? A larger storm could hit the Big Bend region, and you'd see the property values there are just not as high as somewhere in Tampa. So a stronger storm could hit a lower property value area, and you're going to have lower insured and economic losses. The real main problem would be a direct hit on Tampa Bay. So if you go, Hurricane Ian was a little further south a couple of years ago. That was $65 billion in insured losses. We're thinking this one just early could be tens of billions, could be in that $65 billion range. It could be higher, frankly, if it hits as a stronger storm. So that's what happens there. And the path can shift pretty rapidly. So it's going to be down to the last minute before we actually know what will happen with insured losses.
Hey, Matt, if I'm an insurer, why do I even write business in Florida? It seems like these poor folks are getting hammered multiple times.
A lot don't anymore, right?
I guess.
So, yeah, good question, Paul. So a lot don't. The large national carriers that we cover, a lot of them have avoided the region. Allstate is there, Progressive is there, so those are probably the two biggest public insurers. State Farm is one of the biggest there. That's not public. It's a mutual company. The companies that really have, will probably take the brunt of this are Florida specialty writers, so they're Universal Insurance, Heritage Insurance. They focus mainly, if not exclusively, on that Florida market, and those stocks are down significantly in the teens to 20% today.
When we take a look at the insured losses, I mean, maybe tens of billions, you said maybe this is $65 billion range. What do we then extrapolate that the uninsured losses are? Because that was the part with Hurricane Helene that just sort of, the numbers are staggering.
Yeah, so the numbers are early, and I'm skeptical of some of the numbers out there for the economic losses. Typically, the insured loss, maybe you're looking at 40% or half of the losses. But what has happened in these events with large surge and flooding is that the insured portion becomes a lot smaller. The Tampa Bay, I believe it was the Chamber of Commerce, had put out a report in 2020 looking at what if a Category 5 hurricane hit the area. And they had said just residential property losses were somewhere in the range of $300 billion in that event. This probably won't be that bad, and I don't know all the inputs that went into that, but you could see something like that, which would maybe extrapolate $100 billion insured loss. But those were numbers that came out from Tampa Bay.
All right, Matt, thanks so much for joining us. Always appreciate it. Matt Palazzola, he is the insurance analyst for Bloomberg Intelligence in our Bloomberg Interactive Broker Studio back in New York.
Yikes.
We are here. We're in Orlando. And the folks here, again, it seems calm. I was at the park yesterday. People were there. Everybody had their ponchos on. The families were there. I mean, I guess, they're kind of hoping for the best here. But hardy people, those...
Well, we were talking to Trap earlier.
Yes.
From Commonwealth. I was like, oh, did a lot of people wind up canceling? It was just a handful, really.
Right.
There's still 2,000 people here, so maybe a few hundred maybe weren't able to come. But that just shows the commitment to financial advisors. I'm actually surprised we're not tasked with being outside with the hurricane storm. And, I mean, we're not offering. We're just saying we're surprised we haven't been asked there.
That's
all right.
Those people
Oh my gosh, that is hardcore. All right, we are still seeing the sell-off within the bond market. We got you covered for the next hour as well. Coming up, we'll break down the equity moves. Plus, George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, will be joining us on Boeing returning to wage talks. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney. We are broadcasting to you from Orlando from the Commonwealth's National Conference for Financial Advisors. This year's theme is The Future is Now, and the mission is to help build advisors, give them a blueprint for their futures, and empower advisors to navigate business transitions. It's our 10th year that Bloomberg Radio has been there. Coming up in the next hour, we're going to talk to some great guests from here at the conference as well. Virgo Call is President and CEO Investment Advisor at Spring Ridge Financial Group. We'll talk about the markets there. Plus, Chris Maskimovich is the President of Louisville headquarters of Global Wealth Advisors. We'll talk again about wealth preservation plus market commentary. And George Ferguson will join us in just a few moments to talk about Boeing returning to some wage talks after 2 weeks of a strike. So we're kind of now at weeks. But let's kick it all off for you right now with John Tucker with your Business Flash.
All right, thanks to Alex. And this Bloomberg Business Flash is being brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centered support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. Right now, the major stock averages there are lower, pairing some of the earlier losses. S&P 500, 21 points lower. That's down 0.4%. The Dow Jones Industrial Average, 182 points lower. The NASDAQ 100 is down 85 points. That's down 0.4%. Well, traders trimming bets on the Federal Reserve rate cuts, and that has the Treasury yields pushing higher. Money markets no longer see another half-point cut this year. This all comes after Friday's jobs report coming in much, much stronger than expected. Yet 9 of the 11 major industry groups in the S&P 500 were lower. Bob Dahl at Crossmark Global says, you know what, stocks right now are actually too expensive.
PEs are in the 20s. When the P's are that high, things better be nearly close to perfect. So if there's fly in the ointment, whatever that fly is, that 22 PE has got to be questioned somewhat. Hard to see a lot of upside for equities. Maybe not downside, but hard to see upside.
Amazon.com slipping. They had a rare analyst downgrade who's citing concerns over margin trends in the next year. And then Pfizer, that's climbing on news that an activist investor has taken a stake of about $1 billion in the struggling drug maker. As for yields right now, the 2-year 6 basis points higher, just below 4, 398 right now. The 10-year, the benchmark, 5 basis points higher. That is at 4.01%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, JT, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We are live here in Orlando, Florida at the Commonwealth National Conference for Financial Advisors. It is rainy here. We can report that, but no wind.
I see no wind, like literally no wind.
No wind.
Yeah.
So people are out. Again, I was at the park yesterday, had the poncho on. People were out and about. So the good folks, the people that love the Disney theme parks, they really love the Disney theme parks. And it's got to be a lot more than a hurricane maybe to keep these folks away, so it's good to see that. All right, let's take a look at what's happening in these markets. Bailey Lipschultz, that's his job for Bloomberg News. He covers all the equity markets for us. Bailey, talk to us about the insurance stocks. We were just talking to Matt Palazzolo from Bloomberg Intelligence, and he was seeing some weakness in some of the stocks. What are you seeing?
Yeah, a lot of selling pressure, really kind of holistically across insurance stocks, reinsurance stocks. Just looking at the worst performer in the S&P 500, that is Everest Group, ticker EG, down 8.6%. A Bloomberg basket, including a number of these names, down 7.8% for Renaissance. Arch Capital down 5.8%, Sirius Point down 5.3%. A lot of selling. Again, this is all related to Hurricane Milton, kind of quickly intensified on that path towards Florida. Just looking at some of the Bloomberg reporting that the incoming storm may spark the largest evacuation in 7 years. So we're seeing a number of these companies under pressure, as you mentioned. BI calling out the fact that the insurers may see losses in the tens of billions of dollars, depending on how Milton hits the state of Florida, if it does, and whether it hits that Tampa Bay region in particular.
Yeah, brutal. I mean, some of those numbers, though it's always too early, right? They can move so quickly, so fast. All right, let's go to Air Products and Chemicals. That stock's still up by about 7%. There's been a bunch of upgrades after an activist investor took a stake. Walk us through it.
Yeah, so as we talked about an hour ago, company rallying, to your point, after activist Mantle Ridge took a more than $1 billion stake. Jefferies, Evercore, Vertical, all among those companies upgrading shares to buy. Citi opening a 90-day positive catalyst watch on the stock, ticker APD, as you mentioned, up 7.5%. The entire thesis from all of these upgrades really centering on the fact that the company needs to reset its narrative, really needs to focus on being a quality growth company and really tie shareholder returns to those company initiatives. Evercore calling out that there needs to be substantive change to their capital allocation and risk management approach needed before confidence could return for the multiple. So Mantle Ridge, obviously a credible activist, potentially pushing for change, certainly one to keep an eye on. But again, ticker APD up more than 7%, trading at the highest level since 2023.
So wait, did we come up with a Monday activist thing?
I tried.
Did you workshop that with Tucker or what?
He left me hanging. He's not in the studio right now, so I really was looking for his experience, to lend to
Tucker's known to do
ideas.
He's getting his chocolate covered almonds.
Yes. Very good.
All right, what else? Supermicro, though, is getting a nice pop. What's going on here?
Yeah, best performer in the S&P 500. It's not every day that you see a company of this size up more than 15%. This coming after shipment data were seen as a positive sign for demand. Bloomberg Intelligence, Woo Jin Ho calling it out, saying demand is robust and hasn't been dented by those internal issues. So we have that 10K filing delay, a reported U.S. probe. The stock down about 15%. From that Hindenburg short report that really set off the number of issues for the company back in late August. Just also want to call out, though, stock's still down 60% from a March closing high, but right now up more than 14% at the moment. Could also be, guys, just want to point out that this is a company that has been, again, targeted by activist short seller Hindenburg. About 17% of shares currently sold short. So part of the move being exacerbated potentially by shorts wanting to cover those positions. But it's been really a choppy stock for a company right now, trading around $47, having peaked at 118 back in early March.
Yeah, 27 billion market cap up. Even though the stock's down from that high, it's still up 65% year to date. So, boy, you have to have some fortitude to stick with this name. Very good. Billy Lipschultz, thanks so much for joining us. Billy Lipschultz, he covers all the stocks for Bloomberg News. We appreciate getting a few minutes of his time. Another name in the news is our good friends at Boeing. They've got that strike out in the Pacific Northwest, and they got to get those folks back to work. They got to start making planes, get them the cash flow flowing again. So let's get the latest there. George Ferguson, he covers all the aerospace and airlines for Bloomberg Intelligence. He's down in Princeton, New Jersey. George, give us the latest on what's happening at Boeing. It seems like they really need to get some resolution here.
Yeah, I feel like we're in a little bit of the chicken phase now, right? Where it seems like Boeing and the union kind of, slowed down interaction, cut off interaction. I think a federal mediator is calling them back now to try to help resolve the strike. But I feel like it's been a couple weeks here. The union rejected Boeing's 2 offers. And I think, what's going on now is that both sides kind of want to, let some time lapse here and let the other side think about their position and how firm they are in it. And so, to me, it seems like, that probably means there's still a couple more weeks of impasse left because I think folks are trying to figure out how desperate the other side is.
When you said chicken, that's what you meant, right? Like who's going to blink first?
You got it. Yep. We're driving down